So we just hit record. So you'll want to make sure that you give that permission. Nothing else will get out of your way. And
Got my calculator.
it's pink. I want a
Yeah.
pink calculator. I know, I just got like the cheapest one I could find. Then I talked to you guys and I get calculator envy. Like, mine's not pretty.
I put it on my Amazon wish list for my birthday, and my mother-in-law bought it for me.
Awesome.
And my husband gave it to me early because I finished my pre-licensing class the day before my birthday. So he was like, you need to open this because you need it for your test."
Nice. Nice. Nice early birthday present.
Hmm.
So we left each other last night here, specifically talking about debits and credits. And in just a few minutes, I got a little worksheet that or cheat sheet, whatever you want to call it, that we're going to look at that specifically breaks down things that are typically debit and credit to the buyer and things that are typically debit and credit to the seller. So we'll spend a little bit more time talking about that. But like we mentioned last night, for the buyer, it's going to be what they owe, it's going to be their debits minus all the money they have coming in on their behalf for their credits. And that's going to tell us how much your buyer has to bring to closing. And then for the seller, it's going to be the opposite. So we're going to look at how much they have coming in on their behalf as their credits minus what they owe for their debits. And that'll tell us, hopefully, what your seller's going to get. And also, as we discussed last night, there could be times, and there are sometimes times, where the seller's debits are more than their credits. In which case, listing agents, you'll need to let your seller know how much they need to bring to closing. So this is where we wrapped up last night. Do you have any questions or comments before we take off tonight? All right, here we go. Let's prorate. Just jump right into it. So the definition of a proration. All we're doing when we're prorating is we're taking a shared expense and we're making it fair between the parties. So we have a shared expense. What is an example, or what are some examples of a shared expense that the buyer and seller might have at closing?
Property
Property
taxes.
taxes.
Property taxes is the big one, and that's the one we're going to see the most often, right? And it only makes it fair, right? If you buy my house today, it's not fair for either one of us to pay the year's taxes. True? So we're going to make it fair at settlement. We're going to prorate it. We're going to share that expense. Anything else we might prorate?
Homeowners Association dues.
HOA dues, maybe those are monthly, maybe those are quarterly, maybe those are annually, right? But either way, it's going to be a shared expense. Anything else? I know we're heavy residential sales, but if we put our property management hat on, we may also have rent. We could also share rent. So in North Carolina, the when the buyer buys with an existing valid lease in place, they buy honoring that lease. So today, the landlord is the seller, property changes hands, and now tomorrow the buyer will be the landlord. So we want to make sure that the buyer gets their portion of the rent for that month. By the way, making the note on next to property taxes, that could be real property taxes. That could also be personal property taxes. So if we negotiate an outside bill of sale to include the car or the boat or the RV, whatever, then there could be personal property taxes as well, and we would share that expense. So all we're doing with a proration is we're taking this shared expense between buyer and seller, and we're just going to divvy it up and we're going to make it fair. Couple rules coming into prorations. First off, in North Carolina, we consider the seller responsible for the day of settlement. What I mean by that is if we were going to closing today, the seller would pay today's taxes. the seller would pay today's HOA dues, and the seller would get to keep today's rent. So when we're prorating, and only when we're prorating, do we consider the seller responsible for the day? I always remember that this way. If we were going to closing today, when we woke up this morning, when our alarms went off this morning, the seller still owned the property. So they're going to be the one to get the responsibility to pay today's taxes. Fingers crossed and everything goes according to plan today. When we wake up tomorrow, the buyer will be the owner, so their responsibility starts tomorrow. So before we pick up the calculator, just trying to get the ideas and the concepts, the other big idea to get is interim interest. Interim interest is going to be something that the buyer owes their lender. This is not a shared expense. This is only between the buyer and their lender. The seller has nothing to do with this. So interim interest is a debit for the buyer. It's money that they owe their lender. And all we're doing with interim interest is we're getting the borrower caught up on their interest payments. Interest is payable in arrears, meaning built into that word arrears, we can see the word rear. And where's your rear end? Our rear end is behind us. So when you make your mortgage payment on May 1st, you're paying April's interest. When you make your mortgage payment on June 1st, you're paying May's interest. Whenever you make the interest payment, you're making the previous month interest payment because interim interest is paid in arrears. So if we go to closing today, let's look at a picture. If we go to closing today, whenever the buyer originates a new loan, they don't have a mortgage payment the next month. So let me get my, hang on a second. So today is the 21st. We're going to let our buyer go to closing today. They're buying this home today. They're not going to have a mortgage payment on June 1st. They get to skip a month. Tell your buyers they get to skip a month. They just bought a house. This is good news for them, right? But if we go to closing on May, we always skip the first. So we're originating the loan today, no payment in June, which means when our buyer makes their first payment, the first payment will be due in July. And when they make that payment, they are paying June's interest. That's what we mean by paying in arrears. Last night, we mentioned that your principal and interest payment is the same for the life of the loan. Every month is the same as the life of the loan. So if we think about this, why do we not have a mortgage payment on June 1st? Because if we had a mortgage payment on June 1st, they would be charging for the entire month of May. Is that fair to charge interest for something you don't even own until the 21st? So they're not going to charge, they're not going to have a mortgage payment until July 1st to cover June's interest. So what interim interest is the borrower getting caught up. You originated a loan today. Put your lender hat on and pretend you gave me money today. When do you want to start collecting interest?
Right away.
Today. So we're going to collect interest from the day of closing to the last day of that month. Interim interest is always the day of closing to the last day of that month. The lender will debit the borrower, charge the borrower for this amount of days. We'll talk about how in just a second. Debit the borrower for interest for this amount of days, and that'll get them caught up on their interest payment. Comments, questions so far on interim interest? When it comes to counting days, y'all had it good in pre-licensing, didn't you? 30-day months and the 360-day year. Guess what, y'all? We're not in pre-licensing anymore. We're back to the real world. We're going to use a 360-day month, which means we need to know how many days are in each month. And yes, you need to know how many days are in each month for your exam. So there's a couple different methods. You can, the little rhyme, y'all remember this little rhyme? 30 days has September, April, June, and November. All the rest have 31 except for 28. Or Gabe says, Julie, just do the knuckle trick. So if we do the knuckle trick, if you start counting on your inside knuckle or either knuckle, anytime you hit a knuckle, it has 31. So January has 31, February does not. March has 31, April does not. May has 31, June does not. July has 31, double tap. August has 31, September does not. October, November does not, or December. So either the knuckle trick or the little rhyme. But for your exams, we'll need to know how many days are in each month. And you won't have to worry about a leap year. So we know there'll be 28 days in February and a 365-day year.
I had to use 365 method on the test for pre-licensing. Just a heads up.
You did?
Yeah.
Interesting. Even your state exam?
Yeah.
Well, that's interesting. Good to know. Thank you. You said 30 day?
No, I had to use 365. They told me to do 365, I think.
Cool. Cool. So you're good to go. You are good to go. So knowing the days, the number of days in the months, and that's going to help us again kind of do this math. So the question on mine right now is, Julie, do we really have to do this? And yeah, the answer is yes. We do have to do these CDs, and there's two reasons why. One, because you got to pass an exam on this stuff. We talked about 4 questions last night that are on your CD or on your exam. We'll look at those again. Having that understanding of how this works. But the other reason, the more important reason why we need to understand this is because understanding the CD and verifying it for accuracy is part of that old car thing, part of that duty that we owe our buyers and sellers. Who can remind me what that A in old car means?
Accounting.
Accounting. That means accounting for their funds. And isn't their bottom line figures at closing part of their funds? So guys, this isn't just to get you through 302. This is so you can serve your clients, so you can offer them old car. Like we said, you don't have to do it. You're not going to have to complete it in the real world. You do have to complete one in post licensing for your exam. When you get in the real world, attorneys and lenders prepare it, but we do need to have an understanding of it so we can review it for accuracy. So with interim interest, we talked about what it is, but let's talk about how to find it. So there's a couple steps. First off, we're going to count the number of days left in the month. And let's go back to the example that we just used. It was from today to the end of, today from the end of the month. So the first thing we need to do is count the number of days. And if I can offer you guys a trick, please don't just look at that and see 10. You got it wrong. I either want you to do one of two things. I either want you to see that, look at that and say 10 plus 1, or I want you to do a method that I have that's highly sophisticated that'll guarantee accuracy every single time. You guys ready? That's it. Count it out on your fingers. Count it out. The 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 29th, 30, and 31. If you guys look at that and see 10 days, you quite possibly could miss the problem, not because you don't know what you're doing, but because you didn't count the days right. So the first thing we need to do is count the number of days. Remember, you may want to make a note of this because this tends to be a problem topic. We're not prorating. We're not sharing this expense with the seller. This is strictly a debit to the buyer. So the buyer will pay interest for their new loan on the day of settlement. They'll pay the 21st if we were going today for those 11 days in May. Next, we need to find the daily interest. So to find the daily interest, we take the loan amount, whatever the lender's bringing to settlement to closing today, we'll bring the loan amount times the interest rate. When I take the loan amount times interest rate, that gives me annual interest. But remember, I'm looking for daily. So once I have annual interest, then I need to divide by 365. Now that I have the number of days and I have my daily interest, I just multiply the two together, and that will shake out as a debit to the buyer on the closing disclosure. That is money that they owe. Specifically, they owe their lender. Questions? Right. Why don't you guys take a few minutes, given what we just learned, and figure out what the interim interest this buyer will pay. Don't blurt your answer out. We'll give everybody a few minutes to work it, and then we'll come back and we'll work it together. What was that? I thought I heard something.
Gabe coughed.
Okay, sorry.
Just saying.
You guys get something? You need another minute? Thumbs ups? We good? All right. So you got a buyer that agrees to purchase a home for $245,000. They'll get a $200,000 loan at 5.25% interest rate for 30 years. Closing July 18th. And the question is, how much interim interest will the buyer pay? So the first thing we're going to want to do, or one of the things we need to do, is figure out the number of days. So closing is July 7th. I'm sorry, July 18th. There we go. And July has 31 months.
Days.
No, 31 days. July's a long month. So if we are going to charge interim interest to our borrower from the 18th to the 31st, how many days are we charging them?
14.
14 days. So we either counted it out or we did the knuckle trick or whatever. But again, make sure you, anytime you count forward on the timeline, just make sure you are taking into consideration that day that you are counting. So we're going to have, in order for this borrower to get caught up on their interest payment, the lender will charge them for 14 days of interest. The next question is, how much is daily interest? So to calculate daily interest, we take the loan amount times the interest rate. Loan amount times the interest rate gives me annual interest. Divide that by 365. And I get daily interest, $28,767. I would always suggest rounding out at least to the third. The fewer times you have to clear your calculator, the better. But if you do want to round, at least go out to the third until you get to the very end. So we got interest at $28.77 a day. We already know that the lender is going to charge them for 14 days. So $28.77 at 14 days means that there will be a charge to this buyer for interest of $402.74. Debit the buyer, prepaid interest, $402.74. How'd we do? Do we have questions? Good. Okay, bonus points. Who wants bonus points? When will this borrower's first mortgage payment be due?
August 1st. Wait, no, September 1st.
That's it. That's it. We're going to skip that first month. So y'all, even if this closing was on July 1st, we always skip the first. You guys will probably encounter at some point, there's a very strong trend, or there used to be, but there's a very strong trend. A lot of agents like to close on the last day of the month. And the reason being is because if you close on the last day of the month, you only have to charge your buyer 1 day of interim interest. Now, be wary of that because everybody's trying to get into the attorney's office on the last day of the month, right? So, I mean, I don't know, at $28 a day, you know, what's a day or two? But of course, that's up to your buyer. It's worth discussing with them as their budget and everything. But yeah, and that's a great conversation for us to have with the buyer so they understand that mortgage payment won't be due until September. Questions?
If they close July 1st, then they're still not due until September 1st for the
You
first
always-
payment?
Always skip the first. Yep. So then, Kara,
So, yeah.
they would have 31 days of interest for interim interest. Yep.
My realtor spun it to us when we did it that we get we get 2 mortgage payment, 2 months of no mortgage payments. So that, you know, looked a little bit better to our
Pretty
budget
good,
having.
yeah. And of course, you and I know there's no such thing as free, right? The lender's going to get their money, you know, but it's just like exactly how you said it was, how it was spun to you, how it was worded to you. Absolutely. Okay, so we'll see interim interest again in just a minute when we do our CDs. You'll have interim interest on your exams, so we want to make sure we're good. Sure, we're good here. And then the second piece is going to be, we've talked about proration. Now we're going to actually prorate, pick up the calculator. And when we prorate, there's one of 3 scenarios that we're going to deal with. So we're going to look at all 3 scenarios, of course, examples for each, so we make sure that we have a pretty good understanding of proration. The first scenario, if closing is before September 1st, taxes are unpaid. There is no possible way that taxes can be paid before September 1st. Why do I say that?
You don't get the bill until September 1st.
It's not even due until September 1st. So there's no way. The bills don't come out till August. It's not due until September. So if we go to closing today There's no possible way that taxes have been paid. We don't even know at this point what we owe for the year yet. So if we go to closing today, the only thing we have to rely on is last year's taxes, 2024 taxes. So we go to closing before September 1st. We come into this knowing that taxes will be unpaid. Again, when I prorate, I'm such a visual person, you guys. And when I prorate, I like to see what it is I'm prorating. I like to see what we got going on. Yeah, Jeffrey.
I always pay my taxes in August.
For
Mine's
exam purposes, for post licensing, can we say September 1st?
Okay. Yeah, but I'm right. They're paid in August.
Absolutely, you are absolutely correct. But for post licensing and pre-licensing purposes, for simplicity for your exam, can we say September 1st?
If you want to, I'll go along with it
Well,
this
if you want to do it in August, you'll get those questions wrong. I'm trying to help you out here.
No, I thought you were actually being realistic
do.
saying that. I thought, wait a minute, that's not right though. Okay. I missed that part of the conversation when you said for exams, when you said September 1st.
I don't know all taxing counties. There's 100 counties in North Carolina, and we don't know how they all work. So the Real Estate Commission decided that September 1st was a good date, and it's supposed to be easier for you guys to get you through your tests.
Yeah. Okay. I can go along with that.
So when we're prorating, if we were going to closing today, we can set up our timeline, and we're looking at the year being from January 1st to December 31st. And what divides the year, what breaks the year up, is the day of closing. And when I look at this, I can clearly see the seller owns the front part of the year, the buyer owns the latter part of the year. I don't even have to touch a calculator. Who owes the bigger responsibility of taxes this year? Who's going to have the bigger responsibility? The buyer, because they own from tomorrow to the whole end of the year. They have the bigger, the longer amount of time. So we know that the buyer is going to owe more. In this case, for post-licensing purposes, the bill hasn't even come out yet. So when the bill comes out in September, who's going to own the property? Who's going to pay that bill?
The buyer.
The buyer. So when we're prorating, the question I always want you guys to ask yourselves, the burning question is, who owes who? And what I'm telling you guys is somewhere later in the year, the buyer's going to pay. Their buyer will be responsible for the whole year, the whole tax bill. So if the buyer's responsible for the whole bill, who owes who?
The seller owes the buyer in this scenario.
The seller owes the buyer. And how that shakes out in closing disclosure verbiage is a debit the seller, credit the buyer. And specifically, what the seller owes the buyer for is the period of time that they own the property, including the day of settlement. So the seller owes the buyer for 31 days in January, 28 days in February, 31 in March, 30 in April, and 21 in May. That's 31, 28. So the seller will owe the buyer for 141 days. Then we just take the annual taxes, divide it by 365 to get daily. And now that we have daily, we know the number of days, and we can figure out the entry on the closing disclosure. It's a double entry, meaning it's going to show up on both CDs, debit the seller, credit the buyer. So anything unpaid, any closings before September 1st, we're going to do a debit the seller, credit the buyer for the same amount. In a sense, what's happening, the seller is paying the buyer for their portion of the taxes now. if we can hear this, the whole idea of settlement is to settle or finalize everything between the buyer and the seller. And that includes any shared expenses or any monies that need to change hands. So the seller is going to go ahead and give the buyer their portion of the taxes. We're going to have a debit the seller, credit the buyer. And then when that bill comes due at the end of the year, then the buyer will have already collected from the seller. If we think of it this way, that's that much less that the buyer has to bring to closing. That's that much less that they have to show up with. So scenario number 1, before September 1st, always on paid, debit the seller, credit the buyer for the seller's portion of the taxes.
I have a question.
Please.
In like with Forsyth County right now, their taxes going up. What do they still use last year's and just leave
That's all
the
they can.
buyer in the
Yeah.
high and dry when
And hopefully, fingers crossed, taxes aren't going up that much from year to year. But yeah, going up is a very, common thing for taxes to do. So that definitely could be a disadvantage of buying, earlier in the year. We could go to the tax department right now and say, how much are this year's taxes? And they couldn't answer that because they haven't even set the tax rates yet. So
I mean, they said the notice is saying that they're increasing the property values of what they're
Yeah.
using for the tax rate, so by 30%.
But we don't know the amounts yet, the figures yet, so we
Yeah.
can just go on until we know what this year is. We can just go on last year. So yeah, the buyer quite often might get stuck with a little bit of an increase.
Here in Wilkes County, our county commissioners voted to reduce the amount, the percentage for this year down to what it was last year so that the property rate increases won't increase our property taxes. And so we're all for that. But the town of North Wilkesboro and the town of Wilkesboro voted, nah, we're going to go on run with it. So if you live in the city, you're getting charged out the yin yang.
Wow.
Yeah.
Wow. I guess everybody's got their hand out, don't they?
Yeah. So.
All right. So before September 1st, debit the seller, credit the buyer. So now that we know that, why don't you guys take just a minute? There it is. Take just a minute and tell me what the tax entry for this closing would be. We get something? We get a minute? We good? Good. So I got an annual tax bill, 4,900, July 18th unpaid. Of course, the question wants to know what is the tax entry? Again, I'm such a visual person. I like to draw pictures. You guys will be able to have scratch paper for your exam. So whatever you need to draw or see, I encourage you to use it. This closing is almost smack dab in the middle of the month. Seller owns the front part of the year, and the buyer owns the latter part of the year. Taxes are unpaid. So again, the question to ask yourself, who owes who? And we've already decided taxes are unpaid prior to September 1st. It's going to shake out that the seller owes the buyer. But in closing disclosure speak, we say debit the seller, credit the buyer. What the seller owes the buyer for is the time they own the year, which is January, February, March, April, May, June, and 18 days in July. So when we add 31, 20, so when we add all that, January, February, March, April, May, June. Okay. So when we add all that up, I'm getting 199 days that the seller owes the buyer. That's the portion of the year that the seller owned the property. Now to figure out how much, we take that annual tax bill of 4,900, divide it by 365 to get daily. So I get daily taxes of $13.43, somewhere in there. We've already decided it's 199 days. So we take that $13.43 times 199 days, and we have a double entry on the closing disclosure of $2,671.58. Debit the seller, credit the buyer. Questions?
I got 38 cents.
So it's probably from rounding. Did you go out 3?
Yeah.
113.425 times 199 days.
I done 42.
2,671.57. I got 578, and I just rounded to 5.8.
Somehow I got 424, but that's it. That's the difference.
And you know, you can't, let me say this, you can't miss a problem by rounding alone. So if you are a penny off or a couple cents off from me, it's all multiple choice, but the multiple choices aren't so close that they're going to have 58 cent and 59 cent. Does that make sense? So if you're a little off, you'll be able to look at that and say, close enough. Be aware. I would not put it past them to have an answer choice that is off by $13.43, banking on you not counting your days right. So it's important that we get those big numbers right, but we're not going to get, you know, it's hard. It's hard to get everybody on the same page with rounding. So again, go out 3 at least until you get to the very end. Other questions? So this was the scenario if taxes were unpaid, or let me say, this was the scenario if closing was before September 1st. The other two scenarios are if closing is after September 1st. So after September 1st, scenario number one, we're going to closing after September 1st and taxes have been paid. The seller has already paid the bill for the year. So again, we look at our annual timeline. Now let's go to closing. Let's go to closing like the end of October or something. After September 1st. Seller still owns the front part of the year, buyer still owns the latter part of the year. The seller has already paid the bill. Who owes who?
Buyer owes the seller.
Buyer now owes the seller for their portion. And this is going to shake out as a debit the buyer, credit the seller. We're going to have the buyer pay the seller for their portion. Their portion of the taxes start tomorrow and go until the end of the year. Seller pays the taxes today, buyer starts paying those taxes tomorrow. So again, we got the 29, 30, 31. I got 3 days in October, 30 days in November, 31 days in December. Be the buyer's responsibility. Take that annual tax bill, divide by 365 for daily, times those days. And then we know how much the buyer will owe the seller. In this case, think of the buyer reimbursing the seller. Seller's already paid it. Put yourself in the seller's shoes. You've paid taxes, but you're not going to live here the whole year. Don't you want to collect money from somebody? And the only person you're going to collect money from is the buyer. So when closing is after September 1st and taxes have been paid, we're going to do debit the buyer, credit the seller, the same amount. The buyer is giving the seller their portion. We'll see that on page 2 of the closing disclosure. And we're going to think of this as the buyer reimbursing the seller. They're just paying them back. Questions on this scenario? Your turn again. What's our tax entry? We're going to closing on the 24th, same tax bill, and taxes have been paid. We get some? Okay. Let's see what we got. Again, I'm going to utilize my scratch paper because they let me use it, so I'm going to take advantage of that. We're going to closing this time on September 24th. Seller owns the front part of the year. Why aren't you working? Seller owns the front part of the year. Buyer owns the latter part of the year. Closing September 4th, taxes have been paid. So the first thing we're going to do is stop and ask ourselves who owes who. We know the taxes have been paid, then we're going to debit the buyer, credit the seller. Again, that's the TD speak, but really what we're saying is the buyer owes the seller for their portion. The buyer's portion is the day after closing till the end of the year. So the day after closing on the 25th through the end of the year, we got 6 days left in September. I'm running out of room here. Let me get my Zoom toolbar out of the way. I got 6 days left in September. I got 31 days in October, 30 in November, and 31 in December. So the buyer is going to owe the seller for 98 days. I know my annual tax bill is $4,900. We're going to divide by 365 to break that down into daily. So we're going to have $13, 13.425. We've already decided we got 98 days. So when we take the number of days times the daily rate, then we have annual taxes, annual taxes. We have what the buyer owes the seller of $1,315.65. So again, it'll show up as a double entry. It'll be debit the buyer, $1,315.65, credit the seller, $1,315.65. How'd we do? How are we feeling? Thumbs ups? Yeah, it takes practice. It takes a little practice. Again, on the visual, I don't know. It helps me to see it. So I do recommend drawing it out. Try the timeline. I think that helps. Okay, fun with math. All right, the last scenario we could run into, taxes, it's after September 1st. And this time, after September 1st, we're going to closing and taxes are unpaid. So after September 1st, the seller has not paid the bill yet. Any practice problems, closing disclosures, anything you come across, anytime the closing is after September 1st, it will have to specify if it's been paid or unpaid. You can't just know that. They have to tell you that. And what we're going to do in this scenario, taxes are unpaid. So again, when did we just do? Was it October 28th? Let's do that again. So October 28th, seller owns the front part of the year, buyer owns the latter part of the year. And because they're not paid, what we're going to do in this case, or what the closing attorney is going to do in this case, is they're going to do what's referred to as a double debit. They're going to collect what the seller owes, and they're going to collect what the buyer owes. And then the attorney is going to send one check to the taxing authority. Does the taxing authority care where the money comes from? Not even. So the attorney's going, okay, all right, let me help you guys out. We're getting later at the end of the year. We know this is due. So let's just go ahead and take care of this for you. So we're going to figure out the seller's portion, which would be from January 1st to the day of closing. You have the buyer's responsibility, which is the day after closing to the end of the year. Of course, you guys can count those days. Again, taking that annual tax, divide by 365 to get daily, and then times them by the number of days. If I can make a suggestion, I think this is a lot easier to figure out the buyer first, because it's less days to count. So figure out the buyer first and then take the total tax bill minus what the buyer owes, and we know the difference will be what the seller owes. So in this case, what we're going to be doing is called a double debit. It's different money. The seller's going to have an amount for their responsibility. The buyer's going to have an amount for their responsibility. We're going to see these taxes on page 1. When we debited one party and credited the other, we'll see those on page 2 of the closing disclosure. But because we're debiting both parties, we'll see those on page 1. Again, after the break, we're going to look at the CD. Each party pays their own portion. Attorney sends the bill in. The taxes for this year are taken care of. So the difference in after September 1st is if they've been paid or not. And again, the problem has to tell you. Questions? Double debit. Y'all know what's coming next. This time we're going to go to closing on October 22nd. Taxes are unpaid. We get something? So we got that annual bill, 4,900. We probably have that number memorized by now. That's what, $13, 425. That 4,900 divided by 365. This time we're going to closing on October 22nd. Seller owns the front part of the year, buyer owns the latter part of the year. Closing is after September 1st and taxes are unpaid. So what we're looking at now is the double debit with each party paying their fair share. Seller's responsibility is from the first of the year to the day of closing. Buyer's responsibility starts tomorrow and goes until the end of the year. If we count out the buyer, again, because the buyer's got fewer numbers to count out. So for me, I find it easier to start with the buyer. I got 9 days left in October, 30 in November, 31 in December, which means the buyer's responsibility is 70 days. And the seller has the rest of the days. If I take that daily rate times 70, then I get $939.75 that we're going to debit the buyer. The buyer's portion of the taxes is the $939.75. I know the seller owes whatever's left. So we take the 4,900 minus the 939.75, and we got the seller's responsibility, $3,960.25. Debit the seller. So the buyer's portion and the seller's portion. And again, the attorney is just going to collect one check and send it on behalf of the property for this year. Proration. What do we think? How we feel? Good times on a Wednesday night, right? Yeah. You know, again, for me, I'll be honest, for me, it's not so much the math as it is the which party gets the debit, which party gets the credit. So for me, the timeline and actually asking myself, stop and asking myself who owes who. The party, if we were that's okay. If we were going to do a debit one party and credit the other, the days that we're going to count is the party with the debit. So the days that we count are the party of the parties in this case with the debit. Okay. So with prorating property taxes, as we mentioned, another thing we may see is HOA dues. HOA dues can be monthly, quarterly, maybe they're twice a year, maybe they're annually. If you see a problem, it would have to tell you. And the two scenarios I have for HOA dues is they're either paid or they're not. If we're at settlement and they're not paid, then we're going to do a double debit. We're going to collect from the seller what they owe. We're going to collect from the buyer what they owe. And then the attorney will pay the dues on their behalf. If the seller's already paid them prior to settlement, then we'll have the buyer reimbursing the seller. Debit the buyer, credit the seller. By the way, you guys, please be very careful. There seems to be a new trend out there, and I don't know where it's coming from, but there's a handful of sellers out there that say, well, I'm selling my house. I got my house on the market and I'm selling it, so I don't have to pay any HOA dues. What's the HOA going to do if they don't collect?
No lien on your house.
Put a lien on the house, right? So make sure this should go without saying, shouldn't it? But just make sure your sellers are keeping up with their HOA dues, their utilities, their property insurance. They still own the property until that deed changes hands. So prorating HOA. And then the other thing we mentioned that we might prorate is rent. Typically speaking, rent is due and payable to the seller at the beginning of the month. So if you see a practice problem, unless you're told otherwise, go ahead and assume that rent was payable, due and payable on the 1st. With that being said, that means the seller has already collected. So the seller will keep rent the day of closing. And then the seller will give the buyer the rest of the rent for the rest of the month. So again, in CD verbiage, that shakes out to a debit the seller, credit the buyer. The other thing, if you see practice problems or anything about rent, be careful for words like duplex, triplex, quadplex. If you have a triplex, how many times are you collecting that rent? 3 times. So pay attention to those words. Something else that might come up with closing. I know all 3 of you are affiliated, and I don't, you don't have to tell me your firm, but are any of your firms maintaining a trust account? Nope. Gabe, not sure yet. So many residential resale firms are doing away with the trust account because it's a lot of liability. It used to be a lot of disciplinary actions. Remember last night when we said that the material facts were like half of the disciplinary actions? I remember a time where trust account violations were like half of the disciplinary actions. And a lot of real estate firms said, you know what? This is so much liability, and the closing attorney has to have an escrow account. They have to, because the escrow account is how the attorney disperses the funds after closing. So if the closing attorney has to have an escrow account anyway, why don't we just let them handle the earnest money? So this trend happened several years ago. And now what we're seeing is very few residential firms that have a trust account. You get into a bigger brand, maybe a national brand, and they may still have the trust account. If any of you are in or considering going into property management, you will be dealing with a trust account because you're hanging on to security deposits. So with that being said, most of the time when we go to closing, the closing attorney already has the earnest money because that's who the escrow agent is. However, if you ever affiliate with a firm, or if you come across a firm where the firm retains the earnest money, then we have to show how that's going to be divvied on the closing disclosure. Now, I know this doesn't make much sense right now, but we'll talk about this when we have the CD in our hand and we'll see this. But I just want you to hear right now that if the listing firm is holding the earnest money, we need to get it from the listing firm to the closing attorney in time for settlement. The old school way is for the firm to cut a check, give it to the broker, and drive it to the attorney's office. Today, we're handling it on the closing disclosure. So if the listing firm has the earnest money, the listing firm's going to keep it, and they're going to transfer the earnest money from their trust account to their operating account. When you pick up your check from closing, the listing agent, when you pick your check up from closing, your check will be the commission minus the earnest money deposit, because the firm already has that. So we're going to kind of see a different kind of tweak on that. We know the more hands that touch money, the more risky it becomes. Yes. So with this method, fewer hands touch it. It just seems to be a little bit easier. It doesn't have to leave anywhere. It stays there, and it's all handled on the closing disclosure. So we'll revisit. Don't get excited about this just yet. We'll revisit this in just a second when we look at that closing disclosure and see how that's going to shake out, so that the seller pays the full amount of commission and the firm receives the entire amount of commission that they're supposed to collect. So the last little piece of this section is a really nice review of what our responsibilities with this closing disclosure is. And you notice here down at the bottom right, I'm referencing a license law. Specifically, this is 93A-6, which is the disciplinary action by the Real Estate Commission. Failure to properly account for or failure to properly review your client's closing disclosure could result in disciplinary action under license law. So what do we need to know? Well, first off, I need to make sure that the parties receive it, my buyers and sellers receive it, and that it's accurate. And that's where you and I step in and check it for accuracy. When you find a mistake, we got to notify the closing attorney and the lender. This is not the time to get shy. People make mistakes. So when you find a mistake, you just need to pick up the phone, start with the closing attorney, and notify them of the error. Closing attorneys, these CDs are prepared, they have a software. They kind of plug the numbers in and then beep, boop, boop, it auto-fills into the closing disclosure. So, things happen, mistakes happen. So just making sure that we're verifying it. Another thing we need to make sure, if you know of a third party paying any of the expenses, maybe, for example, mom and dad are going to pay for the home inspection. It is okay for mom and dad to pay for the home inspection. We've got to let the lender know, though. So anytime we hear of a third party is anybody but the buyer or the seller. Guys, you and I are a third party. So even if you're offering to pay something, we are a third party. And anytime that anything will be paid by a third party, i.e., not the buyer or the seller, we need to notify the lender. Pretty good rule of thumb. All money that changes hands as a part of this transaction has got to show up on the closing disclosure. And as mentioned, this is disciplinary action worthy. So failure to report errors or any omissions, failure to be accountable, to look at the accuracy of the CD will result in disciplinary action. Y'all, this is somebody else's money that we're accounting for. So we have that duty, that old card duty, to make sure that it's accurate. Questions? All right, let's take a break. And then we'll come back and we're going to look at the CD. We're going to introduce you to the CD. We're going to figure out who pays for what, buyers versus seller. And guess what? We're getting closer and closer to where we actually get to do one. So let's take 10-ish and we'll keep going when we get back.
Hey, everybody. Mic not working again. There she is.
All right. Welcome back.
It's good to be back.
Good to be back. That's good. It's good to be going and doing, isn't it? All right. So, a couple things. One thing I want to look at before we look at the CD. And again, I refer to it as your cheat sheet, which you can, but you cannot use it for the test. So it's a cheat sheet up until the test. And this document is in your Google Drive. So the link that I sent you guys this morning, you're going to find this document. And this helps us decide who's responsible for what, who gets the debits, who gets the credits. We've kind of broken them down into some single entry items, and then we'll see some double entry items. Single entry items will typically only be paid by one party or be responsibility of one party. Double entry items are going to be the responsibility of both. The other thing I had to say about this worksheet is that, or this cheat sheet, is that this is typical. So in other words, unless you're told otherwise, this is how we're going to handle it for your test. But I always need you guys to do this test and to do these practice problems and do what the problem tells you. Always do what the problem tells you. But if the problem doesn't say otherwise, this is what we're going to do. Is everybody good so far? Okay. So we start with some seller single entry items, and we have the seller's debits. Unless we're told otherwise, the seller's going to pay commission. The seller's going to pay to have the deed prepared. They will pay excise tax. And then, of course, the seller is going to be responsible for paying off any of their existing loans or liens. Those will all show up as a debit to the seller. Delinquent taxes. So if they never pay 2024 taxes, 2023, 2022, if they've not been paying those taxes, and obviously that'll come out of the proceeds. And then any personal property taxes due, delinquent and current, will come out of the seller's debits. Buyer's debits are mostly revolved around their due diligence. So if the inspections, any of the inspections, the home inspector will offer, they will allow the buyer to pay for the home inspection at the time of the home inspection. However, a lot of buyers, especially first-time home buyers, may not have that money when they're getting ready to buy a house. So the home inspector may allow the buyer to pay for the home inspection at closing. And whenever we see these expenses, we're going to, for our purposes, know that the buyer will pay for these inspections, debit the buyer. We got various places for those. Homeowners insurance, they're going to pay for their first year's homeowners insurance policy. All homeowners insurance, it's kind of like auto insurance. You pay today and you're covered for the next 6 months. Same thing with homeowners. You pay today and you're covered for the next year. So the insurance company will require payment on the day of closing for that first year premium, which will be a debit to the buyer. Anything to do with the buyer's new loan. So loan origination fees, discount points, interim interest, private mortgage insurance, anything to do with the buyer's loan will be a debit to the buyer. The buyer's going to pay to have their brand new deed recorded. They're also going to pay to have the deed of trust, the lender's deed of trust recorded. So they'll pay those recording fees. I do want to point out, make sure that we see this because this has been some confusion in the past. The buyer pays to have the deed recorded. The seller pays to have the deed prepared. So the attorney's got to get it ready to take it to settlement, to have it at settlement. And because when the attorney is preparing the deed, it's still the seller's deed, the seller gets to pay to have it prepared. It's in the buyer's best interest to have their brand new deed recorded. So they will pay those recording fees. Yeah.
I have a question. Like we do interim interest, is it also, do they do that for homeowners insurance as well? Because you're putting that into your escrow?
So you're gonna pay for the first year at settlement, and then when your forced mortgage payment is due, that's when you start putting it into escrow for next year.
Okay, okay,
So
so
when the bill comes due a year from now, the lender will have that to pay that bill.
okay, so they don't do anything for that first month that you're not paying.
Correct.
Okay,
And remember, they may collect, they'll probably do an escrow reserve. So they may collect a month or two at settlement just to have that cushion, you know, so there might be a couple extra, and then that'll fund the escrow account. But then to make sure that they're covering all months, and to make sure that if that goes up, that they have that money. So that's where that escrow reserve that they may collect at closing could come into place. Title insurance. If a lender's involved, there's going to be two policies. There's the lender's policy and there's the owner's policy. Keep in mind, when we say owner policy, we're referring to the new owner. So the buyer will pay for it, and as soon as they become the owner, title insurance kicks in. The buyer will also pay for the lender's title insurance policy. Title insurance is a little bit different than any other insurance in that you only have to pay it one time at closing. You don't have to renew it. You don't have to pay it every 6 months or a year. You pay for it one time at closing. And title insurance will protect the lender for as long as there's a loan on the property, and it'll protect the buyer, the owner, for as long as they own it. The whole point of title insurance is to protect the owner from errors of the past, things that previous owners did to the property that could not have been discovered in the title search. Last night we talked about that mechanic's lien. The seller said, yeah, I'll do all those repairs. And then they didn't pay him. The mechanic files the lien. The owner, the buyer, has title insurance to cover them. If they have a survey done, then they will pay the survey, the closing attorney's fee. If the buyer hires the closing attorney, then the buyer gets to pay the closing attorney's fee. There's those advanced escrow deposit or those reserves, a couple months of cushion of homeowners insurance and real property taxes. And then there's things that are POC, paid outside of closing, and we have our appraisal and our credit report. These are two things that in most cases, the buyer's not going to be able to pay at closing. The appraiser's not going to go out and do their thing until they've been paid. The lender won't pull the credit report until they've been paid. So when we see the appraisal or the credit report, unless we're told otherwise, we're going to know that they've already been paid and they go somewhere else on the closing disclosure. We want to make sure that we don't charge them for that again. And then we got a couple credits for the buyer. The earnest money will be credited back to the buyer. When we went under contract, we told our buyer, you're going to put down this earnest money deposit and it'll be credited back to you at settlement. So we'll have a credit the buyer for the earnest money deposit. And then the big credit for the buyer on closing day is the loan amount. The lender is bringing the money in on their behalf today. Today, it's a credit to the buyer. The buyer will spend the next 30 years paying the lender back, or 15 years, or whatever the term of the loan is. I've put our proration scenarios on here, the different taxes paid versus not paid, HOA dues, and the rent. Most of the time it's going to be collected. And then we have double entry items, double entry knowing that we're going to see this one item for both parties. So the sales price. The sales price is a credit the seller, debit the buyer. The buyer is giving the seller the sales price. The due diligence fee will be a debit the seller, credit the buyer. Again, similar to earnest money deposit. We told the buyer when we went under contract, you pay this money now, and when we get to closing, it will be credited back to you. We also want to make sure that we debit the seller that due diligence fee. They've already received it. When we went under contract, they received that money. So now we have to reverse what we did when we went under contract. When we went under contract, The buyer gave the seller a due diligence fee. So when we went under contract, the due diligence was a debit the buyer, credit the seller. And now that we're at closing, we're going to reverse that and we're going to do a debit the seller, credit the buyer. Do I have any accountants or accounting brains on the call? No, no. Basic accounting. How do you cancel out a debit? With a credit. How do you cancel out a credit? With a debit. So because we did debit the buyer, credit the seller, now what we're doing is we're pretty much reversing what we did when we went under contract. Couple other things here, just more FYI. If the buyer is going to assume the seller's loan, or if we're going to do owner financing, that'll shake out as a debit the seller, credit the buyer. If there's any transfer of the seller's escrow account or security deposit, or the escrow account, credit the seller, debit the buyer, tenant security deposit in the rental situations. And then if we agree to any outside bill of sale, personal property, again, the buyer will owe the seller. So that shakes out as a credit the seller, debit the buyer. So these are the things that we can expect to see. And honestly, you guys, for these closing disclosures, knowing who's responsible for what is a good chunk of the battle. So as we work through the CD in just a minute, as you guys look at the recommended homework assignment, any other CD problems in Learn, Test, Pass, it's okay to refer back to this. I encourage you to refer back to this, but no, you cannot use this on the test. So it's a cheat sheet up until the test. The other thing the seller's going to have, and I probably need to make a note to add this, but the other thing that the seller's going to have, they're going to have recording fees to pay off their liens. They're going to have a lien payoff recording fee, a mortgage loan payoff recording fee. Any of those liens that the seller's paying off, anything that's specific to them, they will also be responsible for those recording fees.
But we're still assuming that the seller is paying the commission.
Unless you're told otherwise.
Okay.
Unless you're told otherwise. And it'll tell you seller's agent's commission, buyer's agent's commission. So if it breaks it down for you, then we're going to break it down. But if it just gives you a commission, we're going to assume that the seller will pay it. Okay. So this is in your Google Drive. You guys have this available for you. And the other thing I want to look at before we pick up calculators again, I just want to go through and talk about the closing disclosure, talk about the various pieces. I think another big part of this is learning what goes where. So if you do one or two on your own, you're going to get more familiar with where things are. In the real world, as you start reviewing them, you will get more and more familiar with where things are. So first off, when we have this and we're looking at it, page 1 starts with the loan costs. And you can see at the top there that we break this down into several different columns. So I have a borrower paid column, I have a seller paid column, and then I have a paid by others. Remember when mom and dad paid for the home inspection? Mom and dad are others. So that's where we would put that. It's not going to affect either party. But like we said, all money that changes hands as a part of this transaction has to show up on the CD. And again, this is where we can help. We may hear mom and dad say, "Oh, I'm so proud of you. Can we pay for your home inspection?" My little red flag just went up to make sure that the lender knows that mom and dad is paying for it. It's okay for them. It's not okay for me to tell them. Does that make sense? So we've got to let the lender know when we hear things like that. So back to the borrower paid and seller paid. You can see those columns are broken down further into things that the buyer will pay at closing versus things that they will pay before closing. And same thing with the seller, things they'll pay at closing or things that maybe they have already paid. Everything on page 1 of the closing disclosure is a debit to third parties. Everything on page 1 is a debit to third parties. You're never going to see a credit on page 1. You're never going to see money changing hand between buyer and seller on page 1. It's money that they owe other parties. So who are the other parties? Well, that's what we're looking at in the left-hand column. So we got some loan costs, starting out with some discount points and some loan origination fees. That's under A there. When you look under B, we got our appraisal fee and our credit report. And remember, unless we're told otherwise, those things are going to be paid outside of closing, which means they're going to wind up in this column. They've already paid it once. We want to make sure that we're not charging them again. So we'll see that in the paid before closing column. Services the borrower shop for. There's our attorney fee, deed preparation that the seller pays, title insurance, pest inspection, and survey. So the way this is supposed to work, if we tally up A, B, and C, D will be A plus B plus C. So we can calculate all of the loan costs in D. And then we're going to have some other costs, some other debits to third parties. There's our recording fees to record the deed and the deed of trust, the seller's excise tax, prepaids. So we're prepaying homeowners insurance for the first year. If there's a mortgage insurance premium or PMI, that could be there. Make a note for me. Do you guys see where it says F is in Frank 3, prepaid interest? That's interim interest. That's what you and I just called interim interest, because that's what it is we're prepaying that interest. But I do want to point that out, because when I get a call from you guys on the CD, that is usually the #1 call I get. Where does interim interest go? So make yourself a note there that prepaid interest is interim interest. Any prepaid property taxes, which I'll be very honest, I don't know a scenario. I don't know a situation where property taxes may be paid. I've never seen anything put in there, but obviously it might happen somewhere because they have it on the CD for us. It's just not something I've ever encountered. And unfortunately, I just don't have a really good example of when that might happen. But if you're in that situation where property taxes are prepaid, you would know. G is your initial escrow. So those couple of months of homeowners insurance, property taxes, and possibly private mortgage insurance that the lender's collecting would go in G. And then H is other. H is where you and I get paid. Again, it's so funny to think of ourselves as a third party, right? But remember, we're not a party to the transaction. So we are going to be on page 1. The home inspection, the home warranty, and then there's usually some kind of courier fee or wire transfer fee for both parties. So then we take E, F, G, and H, add those up, and that gives us I. And then J is the tally of everything on page 1. Now I'm going to be honest with you guys. When I'm doing these, I'm a little bit of a rebel. And when I'm doing these, I don't mess with D and I just straight line add. If you want to subtotal D and then subtotal I and do J, you're welcome to. But when I do these, when I review these, I'm just looking for the straight line add, and I'm looking for that bottom figure on page 1. What is the tally? What are all of the buyer's debits to third parties? And what are all the buyer's, the seller's debits to third parties? And that's ultimately what we're looking for. That's what we want for page 1. Questions on that? So then we go to page 2. Page 2 where things get interesting. For our purposes, we saw this last night in our sample CD where they had the loan estimate, the final, and did this change. For testing purposes, we don't need to worry about that. So that's the good news. And then on page 2, we have the people's monies, the buyers and the sellers' monies. I want you guys, do you guys have the paper in your hand or are you looking at it on the computer? Okay. If you have it in your hand, let's do a little bit of origami for a second. And I want you to take your paper and I want you to fold it longwise. Buyers are on the left, sellers are on the right. So when we're doing these CDs, when we're reviewing these CDs, we want to focus on one party at a time. So let's start with buyers on the left. All I care about right now is K is in Kelly and L is in Larry. K is all of the buyers' debits, all of the money that they owe, including what we found for them on page 1. You guys see in K3 where it says J? That J is referring to the bottom of page 1. So K is all of the buyer's debits due from the borrower at closing. The sales price is a debit to the buyer. There's closing costs that we tallied up from page 1 for K3. If the buyer owes the seller taxes, then we will put the debit the buyer in K8, 9, or 10. I don't care where it goes. In the real world, it'll be broken down to city and county taxes. But for our purposes, they're just going to give you a tax amount. So as long as you get it in K, we're good. L is in Larry, is all of the buyer's credits. All the money they have coming in on their behalf. L1, where it says deposit, we're referring to the earnest money deposit. L1 is the earnest money. There's their loan amount. Credit the buyer. If the seller has agreed to pay any of the buyer's closing costs, those will go in L5. You can see we have credit the buyer the due diligence fee in L6. And then if the seller owes the buyer taxes, credit the buyer for those taxes in 12, 13, 14. Again, I don't care where you put it, just get it in L. You guys see there's a lot of blank spaces here. This allows for write-ins. One thing we're not seeing on this, for example, is HOA dues. So if we had HOA dues, we would just need to fill that in, type that in. And that's what those blank spaces for the rest of the transaction. I recommend when you start your test, when you start the CD, take a few seconds and write you a big D under K and a big L under C. You guys see that? See your big D, see your big C. So we know K is the buyer's debits, L is the buyer's credits. And then down at the bottom, we have the calculation. I'm going to take K minus L, debits minus credits. Debits minus credits tell us how much our buyers have to bring to closing. Buyers on the left, sellers on the right. So now we'll turn our paper and look on the right side. M as in Mary is all of the sellers' credits. That's a big C. M as in Mary is all of the sellers' credits, everything they have coming in on their behalf. So there's the sales price. And if the buyer owes the seller taxes or HOA dues, we would see those in M as in Mary. N as in Nancy is all of the seller's debits. All the money they owe, including N2, that item from page 1, the bottom of page 1. So all of the seller's debits, that excess deposit, I'll come back to that in a second. J, everything from page 1, we had commission, we had excise tax, we had deed preparation fee. Paying off a seller's outstanding loan or loans would be a debit to the seller. Debit their due diligence fee. Debit any seller paid closing costs they agreed to pay the buyer. And then if the buyer owes the seller for taxes, debit the seller anywhere in 14, 15, and 16. Again, I recommend take your paper, do you a big C in M and a big D in N. So when you get that blank CD, start marking it up. And then the calculation, M minus N, all of the seller's credits minus all of their debits, tells us hopefully what your seller is getting from closing. So debits to third parties on page 1, each individual's figures are on page 2. Money changing hand between buyer and seller and their bottom lines, their bottom figures. Most formats that attorneys use are going to be very similar to this. You might find, in different places, but they're going to be in the sections, in the boxes, K, L, M, and N. Once you start working with a couple attorneys, you definitely get familiar with their closing disclosure, so you know where to find what you're looking for to verify it for accuracy. Continuing with our origami, I want you to take your piece of paper. I just recently heard this and I thought it was adorable. When you fold it longwise, that's hot dog. Now I want you to take your piece of paper and fold it hamburger. Is that just not precious? If we fold our piece of paper hamburger, I can't say it with a straight face. If we fold our piece of paper this way, this will help us with prorating taxes and HOA dues. Taxes and HOA dues are either going to be A, debit the buyer, credit the seller, or credit the buyer, debit the seller. You guys see that? HOA dues are hamburger, or I'm sorry, taxes are hamburger, buyers and sellers are hot dog. So if that helps us see, debit the seller, credit the buyer, debit the buyer, credit the seller. In the event if taxes, we're not prorating, but if taxes are a double debit, remember, buyer's not paying seller, seller's not paying buyer. Both parties are paying their fair share and the attorney's paying their bill on their behalf. If we're doing taxes as a double debit, we're paying a third party, which means double debit taxes will be on page 1, usually under H as a write-in. So I got the buyer's tax portion of the taxes, and I got the seller's portion of the taxes. So it would just be a write-in, buyer's taxes, seller's taxes. Again, this is the double debit scenario. This shows that those taxes have been paid not to each other, but to a third party. So the two challenges, as we're just getting introduced to the CD, the two challenges are knowing who pays for what, who gets the debit, who gets the credit, and just hunting and pecking. Where's all this stuff at? Where can I find this stuff? So again, the more time you spend with it, you guys, you got 3 hours for your exam, so you'll be able to hunt and peck. But you do this once, you do it again, you start reviewing it in the real world, and you're gonna get a better understanding of where things are, and it'll go pretty smoothly once you start reviewing a few. The first couple closing disclosures you review, I highly recommend that you get with your BIC. Have somebody sit down and review them with you, so we know what it is that we're looking for, know what it is that we're supposed to check on to make sure that it's accurate. So if nothing else, spending time with the who pays for what cheat sheet, and also just spending a little bit of time with the blank closing disclosure of where does this go? Because that's what where the time comes in, is as we're learning, trying to get through this test. Questions? You guys have this in front of you. I need to stop sharing this for 1 second. Bear with me here. I don't want to mark up that one. So let me grab. And we're going to do one of these closing disclosures in class together. There it is. There it is.
Can I ask a question real quick?
Absolutely. Absolutely.
Well, it's in regards to what you sent us this morning when you said we could use that stuff. So I brought it up to open it up, and I can't open it.
What doesn't open?
Nothing opens. It tells me I need to get access, and I don't know why.
Can I look at that on the break and get back to you?
Yep, absolutely.
So no
Do you have
access.
2 separate email addresses, Jeffrey? Do you have 2 separate Gmail email? Like, do you have a separate email address?
Yeah, that's the one I opened it. JeffreyCFoster1@gmail.com.
Okay, so yeah, if she's might have sent it, because I had a similar problem. You have to open it, make sure you're opening it with the one that she sent the email to, because that's the one that was given access to it. If that makes sense.
It does make sense. And I thought about that. Hang on.
Thank you, Karen.
I have like 5 Gmail addresses, so I was
but how do I switch it to Gmail? Because it's AOL is what she sent it to. Could you? If I put,
do you have a Gmail, Jeffrey?
I do. Yeah.
But
somehow, way back in the day, I got signed up with Appalachian. I've just left it alone.
Okay. Why don't you throw your Gmail address in the chat, and then on the break, I'll send the links to that email address.
Okay, I can
do that.
Yeah, sorry for the confusion there, but
no. I'm glad you said something. So yeah, shoot me that Gmail, and then in the on the next break here in a minute, I'll send that to you, that email to you again. And you couldn't open the YouTube channel either?
I didn't try that one.
Oh, okay. So yeah, we'll try that on break and see if that doesn't work. Okay. Thank you.
Like I said, I hate technology.
What did Gabe and I say when it started? Gabe is feeling your pain. Technology is great when it works.
Well, I mean, we can get by with this sign language, I mean, I'm getting most of what it says. Yeah, see, okay, great.
Gabe, it's probably about 3 years ago. I woke up one morning and I had no voice. I didn't have a squeak. I had absolutely nothing. And that was like the most frustrating thing in the world, because I had so much to say. Just couldn't get it out. So I know exactly what you're going through, Gabe. You want to be heard. All right.
Gates to be seen and not heard. Smile. And to answer your question, yeah, the YouTube opened.
Perfect. Perfect. Okay. So yeah, you put that in the chat or you will
Oh, I'll just
or
reply to the email, but yeah, hang on.
email or whatever, as long as I have it on break. Okay. The closing disclosure, I'm in Learn Test Pass, the 302 material. Did you get with Becky? Gabe, did you get this worked out? 2 thumbs up. Perfect. Okay. And Carrie, you're in okay? You're Learn Test Pass. Okay. So the closing disclosure, we're going to work together in class. Where'd it go? I just saw it. Okay. It is new closing practice, and together right now we are going to do this closing problem number 1. So we're in Learn Test Pass, and we're looking at this closing problem number 1. And you can see the solutions and the step-by-step calculations, all that good stuff is here as well. But we're just going to focus on this, and then I'll share with you the one I have for our recommended homework assignment once we get done with this. So we have our closing problem, settlement statement problem number 1. How about, I know I'm a little early, but how about we go ahead and take a break? Because I don't want to start this and then have to take a break in 5 minutes. So is everybody good? Let's go ahead and take our break. And then when we come back, we'll be fresh and ready to work through our CD. So I have, let's say 7 o'clock. Let's come back at 7:10. And CD it is, 7:10. And Jeffrey, I'm sending you an email right now.
Do you want us to go and Learn Test Pass?
No, I'm going to pull it up so you can see it. I just wanted you to know where I was getting it from.
Okay.
got to be something about when class starts, because we heard you when we first logged on.
Maybe it's the bandwidth with everybody on.
Yeah, I know Zoom gets, they take on a lot. Many things, I bet. I know my laptop was doing something funny this afternoon, and I gave it to my husband, and then the whole thing went black, and I was like, what did you do? But I left it alone for 10 minutes and it fired right up. But yeah, I thought we were going to be tonight on my couch laptop. That's where I was. But you do what you got to do. All right, let's see. There you go. That might work. We'll see for that tomorrow. All right. Closing disclosure. So again, we're looking at the one in Learn Test Pass. As always, take a few minutes and read just so we know we're all on the same page. So we're told, based on the following fact situation, we're going to answer, this says 4 questions, but we're going to answer 2. We'll talk about that. Answer choices are rounded to the nearest whole dollar. You cannot obtain the wrong answer based solely on rounding. We're told to use the 365-day year method for prorated entries. We're going to consider the seller responsible for the day of closing. Facts. Buyer and seller entered into offer to purchase and contract 2T. The transaction details are as follows. So I'm going to try and do a little split screen here. So we have the information of the problem along with the closing disclosure. I encourage you guys to follow along with me, fill it in, complete it as we go. So you will be your first try at doing one. And then, like I said, we'll talk about that recommended. When you're doing these, make sure you go in order of the problem. Don't try to go by the CD. So go in order of the problem, and we're only going to deal with the information in the problem. So if it's not the problem, then we're not going to have it on the CD. I know so many times we think, well, there's a fee they forgot. If it's not the problem, we're not going to mess with it. We're always going to do what the problem tells us. So the first thing I have is a contract sales price. And a contract sales price is a double entry, which means we're going to see it on both parties. And since it's an amount that affects both parties, we're going to see that on page 2, K and M. Debit the buyer in K, 250,000. Really want to get this all on one page. There we go. So we got debit the buyer in K, credit the seller in M. Can you guys see that okay enough? I know it's not ideal. Can we see that okay enough? Okay. This is where I missed my big projection screen at the training room in Fairway Mortgage. All right, so contract sales price, $250. Debit the buyer in K, credit the seller in M. Guys, that's the whole gist of our 17-page offer to purchase and contract. The buyer promises to pay the seller in exchange for the property. I got a settlement date of October 27th. I have a habit of writing that date on the top of both sides of both pieces of paper, because I know that's a date that I'm going to refer back to a couple times. So it could just save me a few seconds, a few time. So I just tend to write that date at the top of both of my pages. So I have it handy. I have earnest money of $2,000. I also have due diligence of $10,000. Remember, the buyer paid earnest money and due diligence when we went under contract. And we told the buyer, You pay this money now, this money will be credited back to you at settlement. So now that we're here, we want to go under L as in Larry. L1 is going to have our 2,000 earnest money. L10 will have our 10,000 due diligence. And because the seller touched the due diligence, we need to make sure that we debit them that $10,000 in N as in Nancy, N7. The seller never touches the earnest money. So the earnest money is a single entry. Due diligence is a double entry. And then we got financing. We're getting a conventional 15-year loan at a fixed rate of 5.75% for $230,000, with the buyer paying a 1% origination and 2 discount points. So I'm going to go off the CD for just a second and give me a whiteboard where we can work out some of these calculations, where we can see some of these figures. So I got a loan amount for $230,000. I got an interest rate of 5.75%, and I'm just doing this for me so I can see the whole thing. I have a 1% loan origination fee, and I have 2 discount points. And if I go ahead and look at the next line, I can see we're also going to do interim interest. So I just have this all here just for me so I can take what we need, stepping away from the CD for just a second. So first off, we got the loan amount, we got the interest rate. I got a 1% loan origination fee. All of the lender's charges are based off of the loan amount. The only thing the lender cares about is their money. So all of their charges, all of their fees, it's not off the purchase price. All lender charges will be off of the loan amount. So if I have a loan amount of $230,000 and they're paying a 1% loan origination fee, we can see we have, $2,300 as our loan origination fee. And we'll put all this on the CD in just a second. Then the lender is going to charge 2 discount points, again, based off of the loan amount. The number of discount points can be translated to a percentage of the loan. So if it's 2 discount points, the lender will charge the borrower 2%. 3 discount points would be 3%. 1.5 discount points would be 1.5%. The number of discount points will always be translated to a percentage of the loan. So at 2 discount points, at 2% of the loan, I have discount points, debit the buyer $4,600. Then we have interim interest. So the first step with interim interest is to figure out the number of days. Interim interest is going to be from the day of closing to the last day of that month. The buyer is getting caught up on their interest payment. They owe the lender for the rest of this month, including the day of closing. So the buyer owes the lender for October 27th, 28th, 29th, 30th, and 31st. They're going to owe 5 days interim interest. All lender charges are off the loan amount. So I take my loan amount times the interest rate. That gives me annual interest. I need to take my annual interest and break it down into daily. Now that I know how much interim interest is daily and I know how many days, we can just multiply the two together and we find out that the buyer owes their lender $181.77 for interim interest.
I got 181.17.
So let's see. Oh, I do too. I'm sorry. Thank you. Questions on the figures before we go back to the CD, because I'm going to have to erase. So questions on how we got the loan origination fee, the discount points, or the interim interest. Can I erase? When it's gone, it's gone. Not really, but okay. So we'll get rid of this and then we'll go back to our closing disclosure. I'm going to tell you guys a common error that I see is we tend to forget to leave the loan amount off. Please make sure you give that buyer that credit for that loan amount. They need that money to buy the house. So the actual loan amount will go under L2. L is in Larry. The buyer is getting a loan for $230,000. We had a loan origination fee and discount points. Those are going to go on page 1 under A as in Apple. We got our origination charges. So first off, I have my points, also known as my discount points. Borrower paid at closing. They're going to pay $4,600 in discount points. Borrower paid at closing $2,300 in loan origination fee. And then down under F is in Frank 3, we have interim interest. Buyer paid at closing, loan origination fee, discount points, and interim interest. I got homeowners insurance, $800 for the first year's premium due at closing. So remember, insurance is paid for services yet to come. So when you buy your home, you're going to pay for the first year at settlement, and that'll cover you for the first year that you own the property, but you need to go ahead and pay for it at settlement. So we're still under F as in Frank on page 1 under our prepaids, and we can see homeowners insurance premium. In this case is going to be $800. Debit the buyer, paid at closing. We got commission. This is where you and I get paid. I got 6% of the sales price. So we're going to take that sales price and we're going to times it by 6%. Again, in the real world, you're going to see this divvied. Some may go to the listing firm and the selling firm. Some may, depending on the firms involved. For our purposes, they just keep it simple. They're going to give us the total commission unless we have each party paying their own share. And actually, we're going to see that in our recommended homework assignment. So we'll see that the seller's paying their commission and the buyer's paying their agent's commission. But for right now, we're just told a seller's brokerage commission is 6%. How much did you guys get? How much are we getting paid?
15,000.
$15,000. Commission goes under H as in Heather. Brokerage commission of $15,000. Seller paid at closing. Seller's got a mortgage loan payoff of $150,000. So we're going to go back to page 1. Yes, they're paying off a third party, but that third party is acting as their behalf. The lender is acting as behalf of the seller. So lenders acting in behalf of the parties are on page 2, not as a third party. Specifically, the seller's loan payoff is N as in Nancy. And we're going to put that $150,000 in N4. Seller's first mortgage. You have a place there for a second mortgage. If you need to write in more, we're going to put in as many as we need to make sure the seller pays off all their loans and liens. So 150,000 pay off a first mortgage loan. Then I got real property taxes. Seller paid the tax bill for the year, $3,120. Why don't you guys take just a minute with this and then we'll come back and revisit. So seller has paid the tax bill, a total of $3,120. Don't worry about putting it on the CD yet. We will look at that in just a second. Let's see what we got. I'm going to go back to my whiteboard here. So we're prorating, which tells me I want to draw it out so I can see what it is I'm prorating. We're going to closing on October 27th. Seller owns the front part of the year, buyer owns the latter part of the year. The problem tells us, because closing is after September 1st, the problem tells us that the seller has paid the tax bill. So the question I have for you guys is, who owes who?
Buyer owes
Buyer
the
owns the
seller.
seller.
Buyer owes the seller. And how that shakes out is they debit the buyer, credit the seller. That's all we're saying. The buyer owes the seller. The buyer's responsibility starts tomorrow and goes to the end of the year. So we have 28, 29, 30, 31. I got 4 days left in October. I got 30 days in November and 31 days in December, which gives us 65 days. The buyer's going to own the property for 65 days this year, and that's their tax liability, their responsibility. We take that annual tax bill and divide by 365 to get daily. So I'm getting like $8.55 a day. We've decided they're going to owe for 65 days. So the number we're looking at on the closing disclosure is $555.62. Debit the buyer, credit the seller. The buyer's reimbursing the seller. Questions on the math before I erase? Gabe's good. Can I erase? So now that we have a number, let's see where this goes. And again, we can always remember our origami. Don't do that. No, 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 no. So if we take our paper and fold it hamburger, in this case, we said we are looking at a debit the buyer, credit the seller. So we're looking at putting this under K, debit the buyer, and M, credit the seller. And again, anywhere where taxes are listed is fine with me. Just get it in K and M. So $555.62. K, debit the buyer, and then we will do $555.62. M is in Mary, credit the seller. And then we have some miscellaneous expenses. We're told the following expenses should be charged to the buyer or the seller according to standard practice. What's standard practice? That's the cheat sheet you guys have. That's how we're typically going to handle things unless we're told otherwise. So I have an attorney's fee, $1,100. Buyer hires the attorney. So the buyer gets to pay the attorney's fee, and the attorney is a third party. So they're back on page 1. Specifically, C is in cat. C1, I have an attorney's fee, buyer paid at closing, $1,100. Title insurance is a third party. The buyer's paying for the policy that'll kick in as soon as that deed records. So when you guys see, and this has caused confusion, so let's make sure we're good. When it says owner's policy, we're talking about the new owner. Today they're the buyer. Tomorrow they're the owners. Everybody good with that? It's going to cover the owner, the current owner, as long as they own the property, but the buyer's got to pay it at closing when they're still technically the buyer. So title insurance is also under C as in cat. C3, buyer paid at closing. I've got a deed preparation fee. Who pays to have their deed prepared?
Seller.
Seller. So deed preparation, we're still under C as in cat, but we want to make sure we put that $300 seller paid at closing. And then we got some government transfer and recording fees. We're going to find all those on page 1, third party. Specifically, they're going to be under E. E is in Elizabeth. So we got our recording fees. I got my deed for $30. I got my mortgage or deed of trust for $40. Add those up and we get $70 buyer paid at closing. And then we also have excise tax. Excise tax is something that the seller pays. Guys, here's the deal. They're going to tax you when you buy it. They'll tax you while you own it. And they get one more opportunity to tax you when you sell it. And that tax is called excise tax. The seller will always have to pay excise tax. Excise tax is 5/100ths of the purchase price. So what that means, to calculate excise tax, we take the purchase price, in this case, $250,000. Purchase price divided by 500 gives us excise tax. So in this case, the seller will owe $500 in excise tax. This is what I need you to know about excise tax. It's always going to be a whole dollar. So if you divide by 500 and you have change, you need to round up. That's right, Karen. Always up. This is the government we're talking about. Always round up to the nearest whole dollar. So for example, if we calculated this and it was $499.02, I'm going to round it up to $500. Okay. But in this case, I didn't have to round because I divided by 500 and I got a whole number. So the purchase price divided by 500. If you have change, round up to the nearest whole dollar. Seller pays it. E is in Elizabeth, E2. Oops. Seller paid at closing, $500. How are we doing so far? So far, so good? Questions so far? So now we kind of put the problem off to the side and look just at our closing disclosure. Again, technically the way this is done and the way you're going to see it in the real world, they're going to tally up A. You guys see this darker blue box at the top? That's going to have everything in A. They're going to tally up B. They're going to tally up C. And then D will be A plus B plus C. And then they'll do the same thing with E, F, G, and H. And I will be the total. That's sub adding it. And that's how you're going to see it in the real world. For me, even in the real world, when I'm reviewing these things for my agents, I don't pay attention to the tally. In the real world, I just straight line add. I start at the top and I add the figures, not the tallies, but I add the figures, straight line add, and I get all of the buyer's debits to third parties will go in J. Buyer paid at closing, and I'll get all the seller's debits to third parties will go in J. Buyer paid at closing. Makes no difference to me how you do it. I suggest trying to keep it simple now while we are learning. And then when you start seeing things in the real world, you're going to see a lot of extra numbers, but you know that's the sub tallies to get to the big number at the bottom. So take just a minute, whatever way you want, take just a minute and just add. What is the total that the buyer has to pay at closing to third parties? And what is the total that the seller has to pay to third parties at closing? So just add up page 1, and then we'll get back together. So let's see what we got. Let's just look at the buyer first. I got discount points, 4,600. I got a loan origination fee, 2,300. We're paying the attorney 1,100. We're paying title insurance 1,200. I got $70 in recording fees, $800 for homeowners insurance, $181.17 for interim interest. And when I add all that up under J, buyer paid third parties, I get $10,251.17, give or take. And then we do the same thing for the seller. I got $300 deed preparation. I got $500 excise tax. I got our commission of $15,000. So when I add all that up for the seller, I get $15,800. This is all the money that buyer and seller owes third parties. Questions on page 1.
Buying a house is a money racket.
Isn't it something?
It's insane.
I mean, yeah, we do some problems in pre-licensing, and I got buyers, you know, $126,000 to closing and pre-licensing, you know, and I'm like, it is not cheap to buy a house. All right, now that we're done with page 1, this is very, very important. I want everybody to listen to me. The common error on closing disclosures is failure to put these numbers from J where they belong on page 2. So as soon as you tally up J, I want you to take the buyers and the sellers J and put them where they belong. Specifically for the buyer, we're going to look under K3, and we're going to put in K3 how much they owe third parties. And for the sellers in N2, N as in Nancy, we're going to put how much they owe third parties. Number one mistake is leaving those numbers off. So as soon as you come up with J, before you do anything else, please put those on page 2. Now on page 2, buyers on the left, we're going to focus on one party at a time. So buyers on the left, let's go ahead and add up all of K. K is all of their debits, all the money that they owe to buy this home. And then we're going to add up all of L. L is all of the buyer's credits. And then at the bottom, we're going to calculate K minus L. Let's look first at K. We got all the buyer's debits. Their debits include the sales price, everything they owe third parties from page 1, and what they owe the seller for their portion of the taxes. When we add up all of K, we get something similar to $260,806.79. All of their debits. And then we look at L, which is all their credits. So we had an earnest money deposit of $2,000. We got the loan amount of $230. And I got a $10,000 due diligence. We add up all of L. I get $242,000. The last calculation in one of your test questions is to take K minus L to figure out how much your buyer has to bring to closing. And I'm getting roughly $18,806.79. Buyer's agents, once you review your buyer CDs and you're good, you believe it's accurate and you believe it's all good to go, you're going to call your buyers. You're going to say, on our way to the attorney's office tomorrow, I need you to swing by the bank and get a cashier's check or do a wire transfer for $18,806.79 to the penny. And then we look at sellers on the right. M as in Mary are all of their credits. N as in Nancy are all of their debits. And then we'll do our calculation, same at the bottom. Let's take a moment with that. Figure out how much your seller is going to get.
I'll be right back.
Okay.
The German Shepherd had to go to little boy's room. That's what he come to tell me.
It's time. All right, so we look at M, all the seller's credits. We got that sales price. We have what the buyer owes the seller for their portion of the taxes. So when we add up M as in Mary, I get $250,555.62. N as in Nancy, we have all the sellers' debits, all they owe. So that's 15,800 that we calculated on page 1. There's the payoff of their mortgage, debit the seller the due diligence fee. We add up N, and I get 175,800. M minus N tells us your seller is going to get $74,755.62. That's another test question. What's your buyer going to bring? What's your seller going to get?
Now, because I had never actually done this in real life before, but I had never asked the question either. So everything we're doing right here with this paper, the attorney's doing the exact same thing in their office.
Correct. They're preparing it.
But
We're reviewing it.
okay. It just kind of seems redundant.
What's that?
Us doing it and them doing it.
We
When
in the real world, we're not doing it. We're just reviewing it.
Gotcha.
They're going to prepare it.
We're just learning to know what's supposed to be on there and where it's supposed to be. Okay, we're tracking.
What better way to review it for accuracy than to know how to do it, you know? So that's what we're and Jeffrey, to your point, that's why you got 4 test questions on this. 2 of them are going to be what we just did. What does your buyer have to bring to closing? What's your seller going to get? There's one question, there's another. The other 2 questions are, it's like, here's the snapshot of a closing disclosure. What's wrong? So you're looking for what's not accurate. You're looking for the incorrect information. And what we need to know about that is who gets the debit, who gets the credit, you know, so they may have like a debit for the buyer that's on the seller side, things like that. But that's what you're doing with the other half is reviewing it for accuracy.
Okay.
How do we do? What do we think? It's a lot the first time you go through it. Is it horrible? We've done
You're
worse
actually
things,
making
haven't
it
we?
easier.
Do what?
You're actually making it easier, I think. The way
Good.
you're putting
Good.
it. So
Good.
now I'll fill it on the test, but it's easier right now. Okay.
Nope, we're not. So, you know, again, you guys are like, I mean, the attorneys have a software. So they put the figures in and it beep boop boop autofills into the closing disclosure. So Gabe, tell us again the frustrations of technology when it doesn't work. You know what I'm saying? So sometimes the software, sometimes the numbers. So that's why we want to review it. I mean, what if they key in the wrong number? You know, then it's going to, that wrong number will be used all throughout. I mean, y'all, I reviewed one just 2 weeks ago for my agents, and I don't know why, but they charged I remember now, I think it was the buyer. They charged the buyer twice for the home warranty. I don't know why, but they had it, you know, here and here. So humans prepare these things. Humans make mistakes every once in a while. And that's why we just want to make sure for our clients that these final numbers are accurate, that these final numbers are right. So I don't really need to say that. The one I have is our homework recommendation. It's in Learn Test Pass. It's this closing problem number 2, but because there's, I mean, you got 1, 2, 3, 4, 5, you got 6 or 7 practice in here. That may be overkill. Maybe you want something to do fun this weekend for Memorial Day weekend and you got some extra practice here. But my point is, you got plenty of practice here. In order to avoid confusion about which one of these 7 I'm doing as a recommended homework assignment, I've put the recommended homework assignment in our Google Drive. So the only closing disclosure you have in our Google Drive is the one I'm suggesting for homework. Is everybody good with that? So you can just go straight to the Google Drive and grab that CD and work that one. We will work it together next week in class. We'll do it next Thursday as part of our review. So help get you ready for that exam. I probably won't say much else about the CD between now and then, unless of course you have a question. You're always welcome to reach out to me, over the weekend, whatever. But we'll review this. We'll do this one, closing problem 2, next Thursday as part of our review. Sound good? And again, if you get stuck on something, if you come across something and you just don't know, that's when you reach out to me. I tell you guys, I do really good with pictures, with screenshots. Like, show me, take a picture of what you're stuck on, and I'm pretty good about helping you get unstuck.
How many
Okay.
questions are on our exam?
26.
26. Okay.
Yep, 4 of them. So you miss all 4 CD and you still pass the test, but you got to do really good on everything else. I think you can miss like 6.5 or so, which, 6. So, those couple CD questions. And again, you do 1 or 2
3 hours
between
for it?
now and next week, then you'll be good to go. What was that, Kara?
Can we get 3 hours for it?
Correct.
Okay.
But this post licensing has 3 hours because this is the one with the math.
What does it usually take somebody on average? Worst case scenario, what have you seen? 3
I'll
hours?
be very honest. We just got Learn Test Pass in January, and you guys are my first post class with this, so I don't know yet. Y'all gonna tell me how long it's gonna take. But in the past, with previous material, probably about an hour and a half, 2 hours. But we'll see. Yeah, I'll be interested to see how you guys. But you get 3, and I want you to devote 3 hours and use as much of that 3 hours as you need to.
I'll give you a heads up. I'm probably going to be an outlier with time. I'm always super fast. I was with my pre-licensing as well.
Awesome.
So
As long as you pass, I don't care.
I think I finished the state exam in an hour.
Wow. Both sections?
Yeah.
Wow.
I've
Did
done
you
it in
breathe?
35
Or did you
minutes.
click?
Yeah.
What about you, Dave? I did it in 35 minutes. What'd you do it in? 2 minutes? He done it in 2 minutes.
2 minutes. Good job.
So yeah, y'all are good to go. But yeah, so it doesn't matter. Like I said, we're not running a race. This isn't a contest or anything, So just as long as that's all we want, just to pass. So
But it is a
closing problem
contest. We
2
gotta-
next Thursday, part of our review. You don't have to do it. I can't make you do it because it's not in our policy. However, I call it highly recommended because if you do it, then you'll be putting yourself in a better position for your test. Fair enough? All right. Let's
See you
go
tomorrow.
ahead and take a break. What was that, Jeffrey?
See you tomorrow.
No.
Oh, shoot. I thought we were free.
No.
Gabe
This
just
is about an
died.
hour and a half. Let's go ahead and take a break. Shake off the CD. I do have one more thing I want to say about it when we get back. But we're going to say that, and then we're going to go ahead and get started on contracts. Remember, we're going backwards. We've already been to closing. Now we got to back up and put this thing under contract. So let's take 10. Okay. The last thing I have to say about the CD, I don't want you guys to worry about. I just sit back and relax for a minute. Take a breath. You don't really need to worry about this until or if you ever affiliate with a firm that has a trust account. None of us do. So today, none of us have to worry about it. However, what you need to know is if you ever do affiliate with a firm with a trust account, there's a couple things that we need to be aware. So we were discussing earlier when the listing firm has the earnest money, we've got to get that earnest money from the listing firm to the closing attorney for settlement, for closing. And there's one of two ways we can do that. The old school way is the listing firm writes a check to the closing attorney and the agent delivers it to the attorney. So now the attorney has all the funds when they go to disperse after closing. That's old school. Not many people are doing that anymore. Today, what we're doing, instead of allowing the agent to drive around all over town with a check, the listing firm is going to keep the commission. So let's just say, for example, I'm going to make up an example. Let's just say, for example, we're dealing with a commission of $3,000. So commission's $3,000. I got an earnest money deposit of $1,000. So the real estate firm has the $1,000. And instead of cutting that check to the attorney and letting the agent drive it to the attorney's office, the listing firm's just going to keep that $1,000. What that means, step one, for you, the broker, after closing, when you go pick your check up, you will not pick up a check for $3,000. You will pick up a check for $2,000 because $1,000 of your dollars is already there. So you pick up your check, the amount of your commission check will be the commission minus the earnest money deposit. Remember, you guys, this is what we're paying third parties, and you and I are third parties. So we'll only have that, for example, $2,000 on H as in Heather. The seller is contractually obligated to pay us $3,000, right? We got a listing agreement that secured that commission. So we've got to do another charge, another debit to the seller for $1,000. And that's going to go on page 2. And usually where we're going to see that is this N as in Nancy, excess deposit. So excess deposit of $1,000. The $1,000's already at the office. It's already there. After closing, they will transfer that earnest money from the trust account to the operating account. You show up with a check for $2,000 and they have their full $3,000. The seller's been charged the $3,000. The key to that is just how it lays out or where it lays out on the closing disclosure. I doubt many of us will have to deal with this, but there it is. And rest assured, this is why I don't want you worrying about it, because if you ever do join a firm that has a trust account, they'll tell you what you need to know. They'll tell you what their policies are. They'll tell you how they want you to handle it, and they'll tell you what you need to know, including, I want you to just be prepared and know that when you pick your check up, it's not going to be for the full amount. It's going to be that commission minus the earnest money deposit. Anybody have anything to say about that? I don't think so. Okay. All right. So we are going to go back and look at some contract law. 10 and 11, chapters 10 and 11 are contract law. 10 is like basic contract law. Maybe real estate's involved, maybe it's not. 11 gets more specific into our standard offer to purchase and contract. So as a quick review for some real estate contract basics, let's do a quick review, and we're going to play a little game. No, that's not what I want to do. We're going to play a game. So you guys pull your chats up. And I'm putting a link in the chat. I don't know what else I put in there. There. But you should have a link for a word wall. Does everybody see it?
Yeah.
Jeffrey, you see it? You got that?
I got that.
Perfect. So why don't you guys take a minute, click on the link. It's a little matching game of some basic contract terms. Take a few minutes and go through that. And then, of course, we'll look at it together.
You're on mute.
Like Gabe, I'm just talking away. Yeah, was that screeching you back to pre-licensing? All those words. All right. You know how you did. I don't need to know how you did. This is for you, but let's see how we did. And let's just make sure we review and that we're good. So I got something that adds to and becomes part of the offer to purchase and contract, and upon acceptance, the contract. And what we were looking for was the addenda. When you guys see the word addenda, what I really want you to see is the word add. An addenda adds to, and it becomes part of the offer, and upon acceptance, it becomes part of the contract. Let's go ahead and compare an addenda to an amendment. An amendment is a change. We've already agreed. We have signed. The parties are officially under contract. And now we've entered into round 2 of negotiations. Remember last night we were talking about in lieu of repair requests or sellers offering to pay some buyers' closing costs, that kind of thing. So once we're already under contract and the parties agree to the changes, we have amended. The addenda come during the time of offer. The amendment is if we change. Something that declares the contract invalid and returns the parties back to the position they were in before the contract reform. That's a rescission or to rescind the contract. We have a couple examples in where the buyer could back out. And if they rescind their contract, any deposits, any monies they put down, they'll get those back. For example, who can remind me how many days a buyer has to rescind their contract in a timeshare? 5, 5, 5, 10. Y'all remember that? Did they teach that? 5 days to rescind the timeshare contract, which means the buyer signs the contract, they go and review it. They ask their attorney to look it over. They take a minute to absorb what it is. And within those 5 days, they don't want to carry through. They rescind their contract, they get their deposit back, and both parties go about their lives as if this never happened. How many days does the buyer have to rescind their contract with a new construction condominium? Yep. And that's 7 days. That's where you were, Gabe, right? So 7 days to rescind with a new construction condominium, 5 days for a timeshare. The other, so that was our recession. The other breach thing we have in here is specific performance. We're going to talk about money damages. I want to get more specific into that in this little review. But the other option for remedies of breach in this screen is specific performance. So with specific performance, where we're going to see it in real estate is the buyer suing the seller. The seller is terminating or trying to terminate. They're trying to get out. And the buyer is going to go after them in court to make them perform as promised. The seller's obligation in the offer to purchase and contract is to sell, is to provide clear marketable title. And if the seller breaches, the buyer has an option that allows them to go after the seller to make them perform, to make them sell. So we'll look at buyer's remedies. They have a couple choices. If the seller breaches, we'll do a deep dive in our offer to purchase and contract next week. We'll probably even get started on that tomorrow. And we'll see that the buyer's choices, and one of those is to go after the seller, sue the seller for specific performance. Bilateral contract, 2 or more parties agree to do or not to do something. Bilateral contract is what we deal with most of the time. We also have an example of a unilateral contract. And a unilateral contract, only one party is obligated to perform. Only one party has to do something. In real estate, our unilateral contract is the option to purchase, which we will talk about when we get into that next week as well. We'll do a quick review on that. We got an express agreement that we can compare an express agreement to, I don't have it on here. So the express agreement, it's expressed because it's been clearly stated. Maybe it's been stated orally, maybe it's been stated in writing, doesn't matter. It's expressed because the terms have been clearly stated. Most of what we do in real estate is an express agreement, specifically in writing. And we can compare that express agreement to an implied agreement. Implied agreement is just by the actions. You just start acting like somebody's agent versus expressly entering into an agency agreement with them. So most of what we do, everything we do is expressed, specifically in writing. Executed versus executory. An executory is a contract in motion. An executory agreement is it's our contract to closing process. Throughout the process, both parties still have things to do to get to the finish line. So that contract in motion is executory. Once it's completed, once it's been fully performed, i.e., once that deed has changed hands, it is now executed. It is fully performed. It's a done deal. Executed also has another meaning. Does anybody remember what that other meaning of executed was? If something's been executed, if a document's been executed, it has been signed. So when we say the word executed, we could say that it's been signed by both parties. We could also say that it has been closed. So make sure you're kind of using your context clues, right? If you're negotiating an offer and the other agent calls you and says, I'm sending the executed agreement, what they're telling you is that they're sending you the signed contract. And now you can start the executory contract to closing process. Let's see, and down here, consideration. We're going to talk a little bit, and we'll talk a big bit about the essential elements of a contract, and we're going to see consideration. But I like to put it here because consideration tends to be a problem topic. So I want to make sure we're good on that. You know, consideration, what do we always think of with consideration? What's the first place we always go with consideration? Yep. Money, 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 money. That's pretty valuable, right? But don't get that stuck in your head. Consideration is just anything of value, anything you can put a price tag on. And consideration is required for any effective and valid contract. So there's got to be something of value that changes hands as part of this legally binding contract. And speaking of legally binding contract, if we have a valid contract, that means it is fully enforceable and it's going to stand up in a court of law. The parties take that valid contract to the judge and they say, I want to get out of this thing. And the judge is going to say, if you get out, you're in breach because there's nothing wrong with this contract at all. You may remember, we can compare a valid contract, obviously, to an unenforceable contract or an invalid contract. But also remember that word voidable. And with a voidable, we have a valid contract. There's nothing wrong with the contract itself. What makes it voidable is because one of the parties goes to the judge and says, I shouldn't have to carry through with the terms of the contract. A valid contract can become voidable by one of the parties. But again, you heard me, right? The key word there is the judge makes it voidable. The judge decides if it's valid. That's not the job for me and you. So if it ever comes to question, you know, and this is a good reason why we always use standard forms, the NCAR forms. This is why we use those pre-printed standard forms because it helps make sure that we're doing things on the up and up. So a quick little review. How'd we do? Good, bad, good. Thumbs up's good. Good, 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 good. Any questions? This has probably saved us about 10 PowerPoint slides. So I figured this was a little bit more fun. Any questions on these? All right. Let's see. Fix it out. So, also as a little review, it's also important to remember just the basic definition of a contract. And a contract is a legal agreement between legally competent parties to perform a legal act. Do we hear the common word, the common theme? A contract is a legally binding agreement between legal parties to perform a legal act. And this is why this is so important, because you and I are dealing with sales contracts on the regular. We are the ones that are assisting our buyers and sellers to enter into this contract. I mean, y'all think about some of the price tags that come with houses, right? This is a big deal. And making sure that we're doing our part to best protect and represent our parties in this contract process. And that's really what these next couple of chapters about, is making sure that we understand the contract so we can use it and use it to best protect our parties. So let's talk about some essential elements for a valid contract. First off, when we talk about the essential elements of anything, what we're referring to is how the judge, if the judge would determine the document is valid or not. So if you take a contract to a judge and say, hey, is this thing good? They're going to look for those essential elements. If they have all the essential elements, it's valid. If they don't have the essential elements, then it's unenforceable. With essential elements, I always think of essential elements as like required cake ingredients. Has anybody ever made a cake? Has anybody ever eaten cake? We all know cake, right? And we know with cake, there are just certain ingredients that you have to have. Don't you have to have flour and an oil and an egg and water? If you try to make a cake without flour, you can't call it flour. You can't call it cake, right? And that's the same thing we're saying here. If you try to have a contract with without the required ingredients, then you can't call it a valid contract. So specifically what the judge is looking for to determine the validity of the contract, they're looking for mutual assent, also known as meeting of the minds, also known as offer and acceptance. Of all of our essential elements, we are going to spend the most time on mutual assent because mutual assent is what creates the contract. The judge needs to see that the parties came together and agreed to enter into the contract together. So more on that in just a second. Another essential element is consideration. That's that thing of value. In our sales contract, that consideration is the purchase price. In a lease, that consideration would be the rent. Most of the time, consideration is money. But again, don't get stuck there. It could be anything of value. The judge is looking for the legal capacity of the parties. Were they mentally competent when they entered into the contract? And then they're also looking for lawful objective. You cannot have a legally binding contract for an illegal purpose. And in real estate, where we may see some illegal issues in a contract, there could be fraud or forgery. There may be incidences or examples of discrimination. You cannot have a legally binding contract for an illegal purpose. So when we talk about the essential elements, these are the required ingredients that the judge is looking for to determine the validity. And if any one of these is missing, then they either make the contract voidable or void, unenforceable. So I know you guys are new. I don't think you guys have worked with anybody yet. But let's just think for a minute. What would you what if you had a concern about your client's capacity? What if you weren't sure of their mental state? What if when they signed the contract, let's say for example, you say, hey, I got an offer that came in today. When can I come present it? When can we discuss it? And the sellers say, well, why don't you come by this evening after dinner? And you show up at the house after dinner to discuss the offer, and the sellers had a few drinks after dinner. Gabe's already saying, no, I'll come back tomorrow, right? We got to think about when, what kind of state of mind, what kind of mentality. And if you ever have anything that has a flag go up, we need to address it. We need to make sure that this is a real situation. I had a friend not too long ago, and his dad found him a new lady friend. And the lady friend had a condo somewhere else, and she was going to sell the condo and move here. The lady friend is in very early stages of dementia. Now it's very early, but there are still some concerns. You're starting to pick up on it. And this was a concern. Is she in her right mind? Is she capable? Is she able to sell that condo? And honestly, I think what they ended up doing was awarding a power of attorney so she could have somebody just in case, and everything was okay. But my point is, he had a concern. He had a little red flag that went up and was like, okay, I need to make sure that I'm dealing with this. What do you guys think? What if you had a client where English wasn't their first language?
Get a translator.
Get a translator, yeah. Somebody I can trust that I know is translated, because I don't know what they're saying. You know what I'm saying? I know what I'm saying, but I don't know what they're saying. So making sure somebody that we can trust. And that's the one thing our forms don't have. I mean, there's only one language. I mean, there's a couple Spanish forms, but most of our forms are just in English. So again, we just need to kind of be aware. And brokers too. I mean, seriously, you guys, brokers too. Don't try to be helping negotiate, when you're not in your right state of mind. Wait till the morning.
You could also
So-
refer it out to us, to somebody, an agent that speaks that language, and get a referral fee.
There you go. That's a great point, Kara. And every once in a while, you guys, your local, wherever you are, you may have like a local Facebook or whatever your social media platform is. I know in the Triad, we have like Triad real estate agents or something like that, but there's sometimes local groups, and that's a great place to be. So when you need an agent for that need, that's usually a great place to start with your peers to make that request. My teammate and I, several years ago, I was talking about the agent. We went out. Let's see, I met up with him for happy hour, and he and I were, sitting there having a conversation, enjoying ourselves. And a gentleman came on the other side of my teammate and sat down, and he ordered a drink and then another drink. And then a few minutes later, another guy came and met him. So the two of them were sitting there together. The second guy declined the drink. He's like, no, I'm just good with water. The first guy just kept drinking, just kept drinking. And we kind of started listening to the conversation. The guy drinking was the agent. The guy not drinking was the seller. And the more we listened to this guy go on, I mean, it was all my teammate had in him not to get up and say, stop right now. But it just blew my mind that happened. Guys, we're the professional in this situation. Come on. Let's celebrate after. Let's celebrate after the fact. Fair enough? I could not believe what I was sitting there witnessing, what I was hearing. It was crazy. We were looking for, sometimes agents have, when we left, sometimes agents have their cars branded or something. So we were all in the parking lot trying to figure out if we could figure out who it was, but never did. Doesn't matter. But just know that, remember that you're the professional in this situation. So how are contracts formed? Well, like we said, we have to have that mutual assent. We have to have that meeting of the mind. The parties have to agree to come together and enter into the contract. So it's always going to start with an offer. With the offer, there's a couple responses. The seller, assuming that the buyer's making the offer to the seller will always have three choices when they receive an offer. They can either accept it, reject it, or counter it. So an offer is presented. The offeree, the one receiving the offer, has three choices: accept it, reject it, or counter it. We're going to come back to reject it or counter it, but let's just say right now that it is eventually accepted. In pre-licensing, you might have been told that when you see that it's been accepted, we know that it's been signed. In the real world, I need you to verify it. In the real world, when the other agent calls you and says, my guys have accepted, your knee-jerk reaction is to ask, has it been signed? Because guys, if you have verbal acceptance, you have nothing at all. So we need to make sure. You may not get it until later that day, the signed contract until later that day. But when they call you or text you and say, my guys have accepted, we need to take that extra step to verify. So we have acceptance, and then we have our communication of acceptance, telling the other party that has been signed. And then congratulations, we are under contract. When it comes to contract formation, we know by now that I'm a visual person. So when it comes to contract formation, we can think of the contract formation by going back and forth on our contract formation wall. On one side of the wall, I have the buyer, most often acting as the offeror or the giver or the creator of the offer. On the other side of the wall, we'll have the seller acting as the offeree or the receivee of the offer. And it's not uncommon for both parties to come with agents. So we got the listing agent and the selling agent standing on the side of the wall with their party. So an offer comes in 9.5 times out of 10, the buyer's making the first offer to the seller. But again, the seller can make an offer to sell. So generally speaking, the buyer's making the offer, or they're making that first offer to the seller. Seller receives the offer and they have 3 choices. They can accept it, they can reject it, or they can counter it. If they reject it, that offer is dead on the table and there's no reviving it. The seller rejects the offer. They wake up tomorrow and say, oh man, I shouldn't have done that. Can I accept it now? The answer is no, you've already killed it. Could we go back and make a brand new offer to that buyer with those same terms? Sure. It's a new offer. Now we have the seller making the offer to the buyer. So rejection, it's dead on the table. If it is an acceptance, the seller is agreeing to all of the terms exactly how they are. There are no changes with acceptance. And I don't care how small or insignificant that change may seem. If we're accepting, we're agreeing to all of the terms exactly the way that they are. The other option that the seller has is to counter it. A counter offer is a rejection with a but. I'm good with all these terms, but the purchase price and the due diligence amount. I'm good with all these terms, but I'm not good with, seller pay closing costs, whatever. A counter offer is a rejection, but it's a rejection with a but. And with a counter offer, the roles reverse. The seller becomes the offeror and the buyer becomes the offeree. Now I got the seller making a brand new offer to the buyer. And what are the buyer's 3 choices? They can accept it, reject it, or counter it. The offeree always has 3 choices. So let's say we've countered and the buyer accepts the counter and we have verified that it's been signed. We specifically ask, has it been signed? So the offer has been accepted. That's step 1. We have to have acceptance. We have to have all parties initial, sign, and date. And then the second thing that we need for this thing to become a contract is I need that communication of acceptance to cross the line. We've got to see that communication of acceptance going back to the offeror. The person that made the offer needs to know that their offer has been accepted. So really the 2 steps to create, we start with the offer, but ultimately to create that contract, we've got to have acceptance. We have to have all parties sign. And then we need the offeree to communicate acceptance to the offeror to have that acceptance go back and let the seller know that their offer has been accepted. You and I, in the real world, you and I, buyers and sellers aren't communicating. In the real world, you and I are communicating amongst them. Once communication crosses the line, even if you're going from agent to agent, so when the selling agent tells the listing agent, my guys have signed, that communication crossed the line. Congratulations, folks, we're under contract. The next step of the listing agent is going to be to call their seller and tell them the good news. This isn't a call that says you still want this. This is a call that says, congratulations, seller, you are under contract. So communicating to us is just as good as communicating directly to the party. Once you tell us that we've signed, we are under contract. So let's see. Let's run through a little scenario, see what I think. Buyer and seller agents verbally negotiate. So they're on the text, which is how we're doing it today, right? An offer is emailed, and then we're going back and forth on our text on behalf of our parties or emails or whatever. So buyer and seller agents are going back and forth. We finally get to the terms. The buyer signs the offer, and the buyer's agent tells them, we're under contract. Kara's already shaking her head. No, we're not. Why would the agent tell them that? Why would the agent tell their buyer that? The only answer I have is because they don't understand contract acceptance. I have the buyer's signature. Where's the seller's signature? Where's that communication of acceptance? We're a step closer, and we may have a verbal agreement, but at the end of the day, we still don't have anything. But this agent doesn't understand. So they call their buyer and say, hey guys, we're under contract. And the buyer says, sweet, we're going to get on the next flight and we're going to go home because we're under contract. Can we see where this is heading? Not good, is it? So somewhere in flight, oh yeah, the seller gets another offer. Can the seller take it? Yeah, because we're not under contract yet. Well, they give that first buyer a chance to respond, but guess what? They can't because they're up in the air somewhere. And by the time they land, guess what their voicemail says? We've lost that home because we never had a contract. Do I have an upset buyer? Do I have a buyer that thinks that they're under contract because their agent said, what did their agent tell them? So guys, that's the point of this. I really, before you run around telling your buyers and sellers we're under contract, I need you to be sure. Again, you may not have that signed contract right away. So when they communicate that acceptance with you, if you can't see the signature, we need to be sure, we need to make sure that it has in fact been signed. If you got verbal, you got absolutely nothing. Absolutely nothing. I know I was doing an open house once, and a couple came in real quiet, kept to themselves, which is fine. And they got done looking at the house, and I said, you know, is there any questions I can answer? And they said, no. They said, we're just kind of out looking. We're feeling a little defeated right now. We were under contract, but the seller backed out. And I said, oh, I'm sorry to hear that. And they said, yeah, they said they would accept our offer, but they signed somebody else's. And I thought, oh, here we go. They're not really understanding it. And then they said something that really blew my mind. Then they said, we don't play that game. It's not really a game. It's basic contract formation. They were represented. They had an agent, so I let them go on their way. I think they were just kind of out kicking tires, but you could tell that they just had that defeated, that deflated tone to them. And I felt for the guys, but all they had was verbal. So we need to make sure, sure that all parties have signed before we let ours know that they're under contract. I don't know how familiar you guys were in the real estate market around the pandemic. It was, anybody try to buy a house around the pandemic, hear about real estate, Kara did. It was wild, wild west out there. I have never in my 24 years seen any kind of market like we did with the pandemic market. And you guys might have heard, I mean, we had, when I say multiple offers, We're talking like double-digit offers. We're seeing earnest money and due diligence, 4 or 5 digits. You know, I mean, things were crazy. We had a listing. In one weekend, we got 42 offers. That's a lot to consider. That's a lot for the seller, isn't it? And making sure that we were properly communicating with all those agents and with all those contracts. And that's just the way it was around the pandemic. That's what I mean. The wild, wild west buying a house. Kara, I don't know where you were, but I know for a fact buyers were just literally sitting there hitting refresh because homes were on the market for like a couple hours, maybe in some cases. I mean, it was absurd. So my hat's off to anybody that was able to survive that market because it was crazy. My point in all that is to say we need to be sure when we're communicating with that many brokers, with that many buyers, all those sellers, we need to be sure before we give the good news that we're under contract. Like we said, communicating to either party's agent is deemed as communication to that party. So once the other agent calls me and says your offer's been accepted, then congratulations, we are under contract. And keep in mind too, with that contract formation wall, that roles matter. The example we just gave with our contract formation wall was assuming that we were 2 different firms, assuming that we were cooperating. But what if we were in dual agency? Remember, dual agency is all about the firm. So once you tell one of us that we're under contract, guess what, folks? We're under contract. There is no wall to cross. Designated dual agency puts the wall back up. And now you need that communication between the parties. So make sure you know your role, what hat you're wearing in this transaction. So you know when that communication of acceptance has happened and your parties are under contract. Questions on that? So with that contract formation, other responses, we talked about acceptance. We've also talked about the rejection. The rejection is just a flat, hard no. And then you have the counter offer. And again, because the counter offer is a rejection, there is no going back. So once you say no, but that offer is dead and we are now dealing with the counter, you can't wake up the next day and say, no, never mind, I think I'll take that. That offer has been killed with that counter offer. The only thing to do would be make a brand new offer with those same terms. So let's see what we got. Buyer makes an offer through his agent for 150 on a house listed for 200. Yeah, that didn't happen during the pandemic. It was the other way. The seller's offended, rightfully so, right? They got a lowball offer and their feelings got hurt. What are the seller's choices? How can they respond?
Reject or counter.
Let's encourage a counter because sometimes buyers are just throwing out a low offer just to see what happens. You know, so my sellers are going to be insulted, but maybe we counter at, I don't know, 199 or 198. See what happens. What do we have to lose? You know what I'm saying? If they really aren't going to come up from that 150, then it's going to be done. But at least we gave it a shot, especially in maybe a market where it's not a seller's market. You know, we typically see low ball offers in a buyer's market where buyers are out there seeing what they can get. So sellers might be on the market for 5-6 months before they get that low ball offer. So what's it hurt to have a counter, right? What's it hurt to have a counter? How do we handle low offers? Remember, you guys, there's a lot of emotions for buyers and sellers when they're buying and selling a home. And you and I, we don't need to be emotionally involved. We need to be the voice of reason. So when this seller gets offended, when the seller is so hurt over this offer, just explain to them it's kind of the game. The buyer's just playing the game to see if they can get that, to see if it'll stick. You know, encourage a counter offer, kind of see what happens, but understand they're under no obligation to do so. Also with contract formation, asking the question if we have a deal or no deal. Another thing that comes up with contract formation, we have to have reality of consent. If we don't have reality of consent, then we're not going to have a deal. And examples of times that we may not have reality of consent. Mistake of fact about the property or the information in the contract may result in the contract becoming voidable. Fraud is different than a mistake. Fraud is different than a misrepresentation. With fraud, there's intent. The difference in a misrepresentation and fraud is intent. With fraud, you're lying and you know darn well you're lying. With a mistake or a misrepresentation, you're saying something that you genuinely think is true, genuinely think is accurate. If a party has been lied to, whether intentionally or unintentionally, they very well may be able to make the contract voidable. Anybody engaging in the unfair or deceptive trade practices may prove that we don't have reality of consent. And again, if we don't have reality of consent, the contract may be voidable. The unfair or deceptive trade practices is all in the name. It keeps us acting fairly in the transaction and not deceiving anybody. This act does apply to brokers. It also applies to sellers that sell on the regular. So if you get a for sale by an owner that sells a house once every 10 years, it's not going to apply to them. But if you get that investor or that flipper that sells homes on the regular, the Unfair or Deceptive Trade Practices Act will apply. Again, if you find out that you were treated unfairly or lied to, you may be able to make the contract voidable. Duress. Somebody that enters into the contract under duress felt threatened. Maybe they felt that they would be hurt. There was violence. If you don't sign this, I'm going to harm you or your family. If it is discovered, that's right. If it is discovered, and this is the kicker, you're going to have to prove duress to the judge. But if you can prove that you were forced, you were scared not to enter into this contract, we do not have reality of consent, and they may make that contract voidable. And then undue influence. Undue influence is when one party has an advantage over another, and they're taking advantage of that advantage. Where we see undue influence, not a lot, but I think where it pops up, every once in a while you hear about the family that hired the caretaker for their elderly family member, and that caretaker convinces the elderly family member to sell them their home. You know, I'm not going to give you your meds today. I'm not going to take care of you today if you don't sign this. They're taking advantage of their role, of their position as being a caretaker. Again, once the family finds out, they could go after that caretaker for undue influence and make the contract voidable. You know, Mom, if you don't sell your house, I'm not coming home for Christmas. Mom may feel threatened. Now, assuming Mom wants me to come home for Christmas, right? But Mom may feel threatened that if she doesn't sell her house, then she's not going to have, right? So that may make her feel that she entered into the contract under undue influence. So you have a party that has leverage, has an advantage, and they take advantage of that. Mistake of law is rarely an out. What's that old saying? Ignorance of the law is no excuse. It is presumed that we know the law, and if we don't know the law, we can find the law out. So mistake of law is rarely an out. There's a fantastic example in your books, and it's talking about a lady who, she's a widow, and she willed her property to her son. She went ahead and deeded it to one of her sons, and she wanted him to have it when she passed away. So she went ahead and gave the deed, gave him the property. That son passed away. And she said, okay, well, I'll let the property go to my other son. And they said, no, the son that passed has the deed. So the daughter-in-law ended up getting the property because she was the surviving spouse. Now, had she had her will drawn up that had her intentions and not actually gave the deed away, but that's where she went wrong. And it was like went to the Supreme Court, and they decided that mistake of law was not an out. She didn't do it right. And unfortunately, yeah, could you imagine the daughter-in-law who wound up with the property for the son that passed away? So ignorance of the law is no excuse. Either we have access to the law, we know the law, we can find it out. Any questions on our mutual assent or meeting of the minds, offer and acceptance? So mutual assent is an essential element, some form of consideration, something of value. Legal capacity of the parties. There's nothing stopping a minor from entering into a contract, but the minor can't be forced to carry through with the terms. If a 17-year-old takes the contract to the judge and says, I'm 17, you can't make me do this, the judge will probably make the contract voidable. You can't force that minor to perform. Anybody that enters into the contract under the influence may be seen as not have that mental capacity. They may be able to make it voidable, which is why we're not going to let our sellers be drinking when they're signing, because we don't want them to lose that contract voidable. Anybody declared mentally incompetent it will be determined that they don't have that mental capacity, and the judge may also make that contract voidable as well. So any question with the parties' capacities, the judge will rule if the contract is valid or voidable. And then that other essential element we said is that lawful objective. You cannot have a legally binding contract for an illegal purpose. You may note one thing missing from this list of essential elements. Judge doesn't care if it's in writing, does he? Judge isn't looking for it in writing. Now, with that being said, you agree to buy my house on a handshake. You look at me and say, Julie, I want to buy your house. And I say, that's great. Let's do this. You and I have just entered into a contract. It is an express agreement. We stated the terms. We just stated the terms verbally. And everything's going along fine and dandy until one of us does or doesn't do what we promised to do. We take that to the judge and say, well, she said this and he said that. And the judge is going to say, stop. Let me see your contract. Well, we didn't have one. We just shaked hands. The judge will rule that unenforceable. They can't make a decision. They can't come to a decision because they don't have that in writing. So oral agreements are unenforceable in a court of law, which is, again, why in real estate we have something called the statute of frauds that requires these contracts to be in writing. It's not the judge that requires it. It's the statute of frauds that requires it to be in writing. A couple of different ways that an offer can terminate. Note that word offer. So a couple of different ways that we can terminate an offer. Well, we've already said a rejection and a counteroffer will terminate an offer. The offeror, the person making the offer, is free to revoke their offer at any time prior to acceptance. I'm going to say that again. The offeror, the person making the offer, is free to revoke their offer at any time prior to acceptance, even if they put an expiration date on it. So I make you an offer. I say this offer is good until 5 p.m. tomorrow night. I wake up tomorrow morning and say, nope, I don't want to buy it. As long as I haven't had received acceptance from you. Destruction of the property will terminate an offer. So if the house burns down, tree falls on the house, or death or insanity of either party. And please make a note here, you guys, a mental note. Death is only an out when we're negotiating the offer. Once we're under contract, death of either party is not an out. And we're going to see when we look at our contract that it says this contract is binding to the parties and their heirs. So death is only an out when you're negotiating the offer. Once you're under contract, if the parties pass away, their heirs are expected to carry through with the terms of the contract. And if they can't or won't, then they're in breach. We just mentioned the statute of frauds, get it in writing. That's what the statute of fraud tells us. You can negotiate orally, but you can't bind anybody with a handshake. You can't bind anybody with a verbal agreement. The statute of frauds. And again, this is where it's so helpful that North Carolina Association of Realtors has provided us with the pre-printed forms. They took that piece away, made it easy for us, standardized the forms so we're familiar with them and we know what we're doing on the regular. So speaking of the North Carolina Association of Realtors, they're a great resource. They have a plethora of information. Now that you guys are all affiliated, you have a log on. They're going to ask you for your NERDS number, that NAR number you got. You don't have to memorize that one. But once you get into NC Realtors websites, there's some good stuff in there. So I encourage you to kind of poke around and learn about what they have to offer. And one thing that they do that I personally love, they send out an email every once in a while, and it's like a legal Q&A. So somebody has emailed the attorney with NC Realtors and asked them a question, and the attorney shared that answer with all of us. So when you're poking around NC Realtors, look for that legal Q&A and sign up for that email because it's good. It's really, really interesting. So we have a scenario here from that legal Q&A. So let's take a look at this and see what we think. Yesterday, I sent a signed standard form offer to purchase and contract to a listing agent through email. The listing agent emailed me back with a counter offer, but his email did not have a contract attached to it with a seller's signature. My buyers liked the counter offer, so I emailed the listing agent back without attaching a new contract and told him that my clients had accepted the seller's counter offer. So what we're saying here is an offer was made, and instead of using the paper, we just went on using text or email or whatever form of communication. We were negotiating back and forth without signatures. And in the end, we have the buyer's signature, but we still don't have the seller's signature yet. So the listing agent contacted me today and said that the sellers have received another offer and that the sellers will be reopening the listing to accept the highest and best offer. I explained to them that we could not do that because we were under contract, but he claims that we are not. My clients are very upset. Is the listing agent correct? Kara's adamantly saying, yes, this listing agent's correct. Gabe's agreeing. Jeff's weighing in. Yeah, because what's the piece that we're missing? The seller never signed anything. All we have is the buyer's signature. So again, you guys, here we go again, back to technology. Technology has done great things for us, but there's also things that we still need to make sure that we are touching, make sure that we have our hands on. It used to be we would negotiate and counter on paper. We're not doing that anymore. We're doing it via text. We're communicating with the agent, with the other agent via text or email. And that's all fine and dandy, but we don't have anything binding until we have both parties sign and we have that communication of acceptance across the line. So just make sure that you're clear when you're communicating and you know what's up. Yeah.
There's no buyer contract signature either, because they just said they didn't attach a new contract. They just said that they liked the seller's offer. So there was never a
Okay,
contract
yeah.
exchange.
That's right. So I got nothing. You're right. I don't even have buyer signature. I mean, we don't even have that. So we literally have nothing here, you know, and the fact that another offer came swooping in, well, good for the seller, you know, because they have an objective to sell their home. Again, the buyers were the ones that got hurt in this scenario. You know, the buyers were the ones because they thought we were under contract. Words matter. Let me just say that words matter. And remember, you guys, the public doesn't speak broker. So when you're talking to the public, make sure that we are, you know, talking to them in a way that they can understand for themselves. We're not dumbing it down, not at all. But we're just making sure that they understand what we're saying as we have these communications with them.
Is that a case where they could report their agent?
They absolutely could. Could this be a disciplinary action? Did they violate some rules? They absolutely could. This is what I want you guys to hear me say. As we're negotiating back and forth, may that be text or email, even if we're negotiating back and forth on the phone, what did we say last night? Document everything. Everything. So if that agent calls you and says, this is my guy's counteroffer, it's suggested that we ask them to text it or email it to us. Because if they call me, what do I have? I have nothing. But if I can get a text, at least I can show that we went back and forth. Does that make sense? So if we're going to go on the phone, that's fine. If we're going to go in person, face to face, that's fine. But we still want that documentation in the event it goes down. That's what this is all about. If this goes down, we want to make sure you guys are protected. So document everything, especially when you're negotiating, when you're working back and forth with that buyer and seller. By the way, this NC Realtors legal Q&A, that's part of our member benefits. Did y'all know through NC Realtors, we have access to attorneys? You can email the attorney down there. You can call the attorneys. So, you know, here all the time, what do I get with my benefits? Yeah, we have access to an attorney to address questions like this. So again, just make sure you're exploring, you're poking around, and you're taking advantage of the things of those member benefits. At some point in our time together, probably maybe even next week, I do want to go out to the Real Estate Commission's website for just a few minutes, poke around, show you a few things out there, just to help, you know, because sometimes we're trying to explain these things to buyers and sellers and they don't know what we know. And they may not understand the process like we do. So the commission provides supplemental material, educational material, Q&A brochures, various things to help us better explain it to our buyers and sellers. So that's one thing we'll do in our time together is just go out to the commission's website and poke around and get you guys to get exploring all those tools that you can use. The commission says, if it's on our website, you're welcome to use it because we all have the same common goal of educating the public. And that's what we want to make sure that we're properly educating the public. Questions or comments? So I say we go ahead and take our last 16-minute break. What do y'all think? All right.
Preach it.
So,
Preach it.
yeah. So we're going to do this again tomorrow. Tomorrow we'll probably start getting going on 2T. I'm not trying to get through it tomorrow. That's a big chunk of what we have left. Did y'all hear me say we were going through that thing word for word? So tomorrow we'll get going on 2T. We're also going to address some of the commonly used addenda that we might see with 2T. So the tomorrow and into next week will be where we are with that. So that's what I'm going to say for tonight. Y'all have a good night. We'll do it again tomorrow.
Thank you. Have a good evening, all of you.
Thank you. Good night.
Good night.